efficient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bull cases have gone away.
We continue to have this have and have not economy.
I think the market at every step has been worried about inflation.
There are certainly parts of the market that are very frothy.
The next couple weeks we think are going to get a little choppy here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is not the year-end rally you were looking for. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. And this is what the price action looks like. We're down again. After a three-day losing streak, you could make that day four. We're down by 0.9% on the S&P. We're negative 1.3 on both the NASDAQ 100 and the Russell 2000. Lisa, the losses are adding up.
And they're adding up in all the wrong ways, given the fact that this has been negative momentum for quite a while. We've talked about bad breath. We need to continue with that because it's been 14 straight days of more losers than gainers in the S&P 500. This was the comment from Michael Hartnett over at Bank of America. Breath, global equity breath, remains dire.
The longest streak on record, according to Jim Reed at Deutsche Bank. I've got to say I was stunned by that. That's how bad the run has been. It's incredible.
And it shows how much it's been dominated by the high flyers. This is creating some concern by a number of people who already have been concerned by how high things have already gotten. You put it really well earlier this morning when you said, ultimately, it's not just that the Fed came out and signaled that they weren't going to cut rates as much as expected in 2025. It's that we were coming from such a high place that was high enough to make people nervous just by virtue of no one out there being particularly bearish.
I wanted to give one analyst, one economist, one strategist some credit as well. Torsten Slok over at Apollo. We shared a quote with you from some research of Torsten's over the weekend, and it read as follows. Recent inflation readings show signs the decline in inflation has stalled, and there is a risk of re-acceleration. For investors, the risk is a repeat of 2022, where the 60-40 portfolio underperformed significantly. Is Torsten onto something into 2025?
If the current price action continues, absolutely, because what you're getting is concern that maybe yields are going to be significantly higher than people previously thought. The Fed isn't going to offer up the same level of put as they had before. At the same time, all the good news has already been baked in, and now we get to sequencing and what happens in Washington, D.C., which, as we can see, tends to be a little bit fraught.
Anne-Marie's going to join us on that in a moment. Bond yields are lower this morning by a few basis points. There's one stock that we're watching. Novo Nordisk is getting absolutely hammered over in Europe. That stock is lower by more than 16%. An experimental obesity shot, losing less weight than predicted in a study. They're doing badly. Who's winning off the back of that? Lilly. Eli Lilly up in a pre-market by a little more than 4%.
This is a heated competition between Eli Lilly and Novo Nordisk over dominance in the weight loss drug category that's been a complete high flyer. Just give you a sense of how small the margins have to be for this stock to respond this kind of way. The shot helped patients lose an average of 22.7% of their weight over 68 weeks. This is the Novo Nordisk drug versus the expectation of at least 25%, and that was enough to sink them at a time where they're neck and neck. It also sank the Danish stock market the most going back to 2022. Again, this goes back to breadth, narrow breadth. The gainers are the ones that are lifting everybody, and there's a lot of weakness under the hood.
Just to be clear, that is the Danish stock market. Like, that one stock is the Danish stock market, and that ultimately is the problem for the Danish stock market.
Well, yes, and it also is telling that the Danish stock market is composed of a stock that sells significant amounts to the U.S., not necessarily to the Danes.
Number 2, waiting on the Stock 600 as well. So the Stock 600 over in Europe having a difficult morning into the afternoon. Coming up on this program, we'll catch up with Jim Carroll and Morgan Stanley on the healthy sell-off in equities. Anne-Marie joins us from Washington on the latest spending fight, and San Francisco Fed President Mary Daly on the Fed's outlook for next year. Don't miss that. That conversation starts at about 7:30. We begin this hour with stocks on a 3-day losing streak ahead of fresh inflation data at 8:30 Eastern Time. Traders also keeping one eye on Capitol Hill as a government shutdown deadline nears. Jim Carroll and Morgan Stanley writing the sell-off in equities is healthy. Better to happen now when year-to-date equities are up more than 20% versus early January and start the year in a hole. Jim joins us now for more. Jim, welcome, buddy. It's good to see you. What's healthy about this?
Good morning. I'm sorry, I didn't catch that.
What's healthy about this? 14 days of negative breadth on the S&P. What's healthy about it, Jim?
Yeah, so look, I mean, the markets were technically very overbought. This sell-off does not represent a change in trend. As you were saying earlier on the show, there's been a very heavy concentration in a very few names. That narrowness of breadth has already started to widen out. But when you get these big adjustments and you get these expectations of earnings still coming in good, but maybe not as stellar as people had thought in the past, then I think you start to get the sell-off. Look, I mean, the S&P 500 was up about 27% on a year-to-date basis, and we owed that to a very, very few set of names. This is now starting to broaden out, and as the market broadens out, what that means is that the former winners are going to start to decline a bit. Doesn't mean it's the start of a bear market. It just means that we're in an adjustment process of broadening out the markets, moving into sectors that are more mid-cap orientated, which is our view, that we think can potentially do better from an earnings growth perspective.
Jim, did anything change for you Wednesday afternoon when Chairman Powell finished speaking?
It's kind of interesting, right? Because this is the dilemma for the market. All Powell basically did, yes, he did announce a slower pace of rate cuts. The dots did move up 50 basis points across the curve. But guess what? That's almost exactly what the market was expecting. If you looked at Fed funds futures prior to the meeting, and then after the meeting, they were, they were a little bit higher, but they weren't materially higher. I think what the market's reaction is here is it's really about the bond market. So effectively, where people are starting to get nervous is from a positioning standpoint. If you look at year-to-date returns in bonds, it's in the low single digits. It's around 2 to 3%, let's say, for most of the ag indices. If you get another 25 basis point rise in yields between now and year end, which is possible, and you get a widening of spreads, many bond investors are at risk of losing their whole year in the next 2 weeks. That's not our forecast. That's not our base case. But it does create this riskiness that you could get these extended sell-offs in the market, yields rising, and that could have a negative impact on equities. So we have to put this into context and understand those technicals as well.
Jim, I'd like to dig a little bit more into that. At what point is that the reason why you're not buying bonds right now, even though they've sold off? And generally, you're optimistic about the disinflationary narrative. You still think you want to wait for a greater sell-off. What's the point? What's the trigger for you to buy?
Yeah, so look, I mean, the place that we're looking to line up and buy, really, our holiday shopping list is really going to go towards the equity market, because we have to understand why is the Fed willing to cut rates by less? It's probably because the economy is doing a bit better. That's good news for equities, right? And so moving into mid caps, active over passive, materials, more cyclicals, all of that. Now in bonds, though, I think that at this level, I think this is an area where bond yields can kind of hang out. I'm looking for an overshoot. I'm looking for bond yields, 10-year treasuries, let's use that as a proxy, to move up towards about 4.75% before I would start to get long duration, extend my positions in bonds. Because at the end of the day, I still think the Fed is going to cut a couple of times next year, which means that the upside in yield for bonds is somewhat limited. And this is why when you look at a 60-40 portfolio or a balanced portfolio in equities, that it's not quite like 2022. There is some upside, potential upside, stopping of yields. We're just not in the same cycle that we were back in 2022. So I think the setup right now going into 2025 is much more healthy because it's giving you higher bond yields, potentially wider spreads, so therefore more value for 2025, and you're getting a sell-off in the equity market in areas that you maybe wanted to rebalance into in the first place, and here's your gift, here's your opportunity to do that.
So, Jim, just putting this all together, it sounds like it's overly simplistic to say simply higher yields causes the sell-off in the stock space, right? So it's not that alone can make you bearish, but that tied with the context, as John was pointing out, of the high-flying aspects of the market were really the reason why. This is a positioning move. It is not some sort of longer-standing trend. Is that right?
That's right, yeah. So we don't see this as an economic fundamental change in trend, right? We still think the labor market is reasonably strong. We still think that the retail sales data, we still think the broad economy is still doing okay. We do not have a recession forecasted into 2025. The issue that we have in 2024, though, was that we had a significant acceleration in the earnings growth rate for many of these Mag 7 type companies in the top 10 and much of the tech. And we don't expect that kind of an acceleration in earnings for those companies in 2025. So now, because there's such a high concentration of the index at this point, as their earnings slow to a more normalized pace, then what that means is that there's a rotation that takes down the index because there's such a high weight in the index, but then it gives you the opportunity to buy other segments of the market that are more cyclical, like materials, industrials, for example, that can actually have a better earnings growth rate going forward and potentially even a PE multiple expansion. So that's what 2025 is about.
Jim, just ahead of this conversation, we talked about Torsten Slok and Apollo and the risk of a repeat of 2022. Could I get a little bit more color from you on that? The risk of that actually developing, stocks and bonds really struggling next year?
Yeah, so in 2022, I mean, we started from a very low interest rate level, and the amount that rates could rise was quite significant. We were just earlier in the cycle in 2022 for rates to rise. At this point, we're probably later in the cycle, and in interest rates, yes, they can rise. I mean, there's no question if inflation starts to pick up, but we're also not at a point here where we expect inflation to be high single digits like we did back then. Inflation is likely just to say, well, we're not going to get to target at 2%. Maybe we'll stay at 2.5%. Maybe we'll go to 3%. And the market's not yet forecasting rate hikes by the Fed. And so I think that's a big difference, right there in terms of the bond element to this. On the equity side, what we have to recognize is that an acceleration higher in interest rates, like what we got in 2022, will bring down the present valuations of a lot of those equity assets. If we're not likely to get the same acceleration higher in interest rates in 2025 as we did in 2022, then we think the earnings setup, the earnings path for 2025, it might be a little bit more muted, but certainly still positive and still okay. So I don't think the setup is quite the same as 2022 right now.
Interesting. Jim, appreciate your time. You've been a good friend of the program through the year and a whole lot longer than that. Thank you, sir. Merry Christmas and happy holidays. Jim Caron there of Morgan Stanley. Jim, on the bond market this morning, by the way, down 2 basis points on a 10-year, down 4 at the front end, on a 2-year at 454. Jim making a case for 475. Before we start to see some buying come in, from him at least.
Yeah, that was when he would get bullish on duration at a time where there is a real eye toward not providing losses for your investors if you're a bond fund manager. I thought that was a good point. It was a salient point about positioning at the year end, given the fact that gains have been so meager overall. Total returns of 5 to 6% doesn't give you a lot of room to work with.
Going into year end, the losses are building. We're down by about 1% on the S&P 500 now, looking to close out the trading week potentially on a real low. With an update on one single stock and a whole lot more, let's get across the Bloomberg Briefs. Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Novo Nordisk are plunging more than 18%, wiping out more than $100 billion of market cap. In one of the most anticipated drug studies of the year, Novo's experimental weight loss drug, CagriSema, disappointed, with patients losing about 20% of their weight after 68 weeks. That's below the 25% weight loss Novo previously said the drug could deliver. Eli Lilly, which makes a rival weight loss medication, Zepbound, is getting a boost on the news, with shares rising 4.8%. Meanwhile, Starbucks workers are planning a 5-day strike after bargaining talks hit a snag. Employees in stores across Los Angeles, Chicago, and Seattle will walk out of unionized locations beginning today after failing to reach a deal on better pay, schedules, and hours. The union expects the strike to spread to hundreds of stores by Christmas Eve, while Starbucks claims the union prematurely ended negotiations. And the Pentagon has shipped anti-drone technology to New Jersey amid continued sightings of mysterious aircraft. The Defense Department saying they sent equipment able to both detect drones and disable them. The government has claimed most of the sightings have likely been commercial or hobbyist drones and has temporarily banned drone flights over nearly 24 areas of New Jersey. The mystery continues. That's your Bloomberg Brief. John?
Yahara, thank you. I can't believe we still haven't figured this out.
I just love this. It's sort of like, you know, you have a big mess and someone just hands you a roll of paper towels, basically says, all right, get to it. And it sort of feels a little bit like that. We'll send you a kit.
Anne-Marie will join us shortly. She's got answers down in Washington, D.C. No one in Washington, D.C. seems to have answers.
I will say that my younger son just got a drone for a birthday present, and I said...
A big one or a small one?
Small one. I said, not a good time. He said, let's go fly. I said, absolutely
What does he want to do with it? What's the whole purpose of owning
It's just kind of cool. It just flies around, goes...
It has a camera on it?
I doubt it. I'm not going to allow that.
Okay, all right. Okay, tell us more in a moment.
It's okay.
Up next on the program, on the brink of a government shutdown.
It is, I think, really irresponsible for us to risk a shutdown over these issues on things that they have already agreed upon. We will regroup and we will come up with another solution, so stay tuned.
Stay tuned. That conversation up next from New York. This is Bloomberg.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
I am right there with you. We want a quiet end to the year. We're not getting one. We're down 1% on the S&P 500. The losses are piling up. 3 days of losses into Friday. This is day 4. We're down across the board. On the S&P, on the NASDAQ, on a Russell. At least the bond market is picking up some slack. Yields are down by 2 basis points. The 10-year 4.5362. Under surveillance this morning on the brink of a government shutdown.
It was just last spring that the same Democrats berated Republicans and said that it was irresponsible to hold the debt limit, the debt ceiling hostage. What changed? It is, I think, really irresponsible for us to risk a shutdown over these issues on things that they have already agreed upon. We will regroup and we will come up with another solution, so stay tuned.
So here's the latest going into the weekend. Government funding set to expire at midnight tonight, setting the stage for a potential shutdown after the House voted down a stopgap bill backed by President-elect Donald Trump. 38 Republicans joining a chorus of Democrats in voting against the measure that would have suspended the debt ceiling until 2027. Anne-Marie joins us now for more down in Washington, D.C. AMH, is it shut down on going into the weekend?
Yeah, it certainly looks like we will see a government shutdown. The question now is whether or not it'll be short or potentially be longer. How much into January potentially could this go? Some Republicans are saying shut the government down till January 20th, the inauguration. A lot of questions that we're waiting for answers today. This hour at 7:45, we will have Vice President-elect J.D. Vance with Russ Vought, who's going to be the director of the OMB under Donald Trump, meeting in Speaker Johnson's office, according to Punchbowl News, with House Freedom members. And these are the individuals that voted this down, that do not want to see an extension of the debt ceiling. That's potentially where we can get read some tea leaves into what can come next. But they're all in a really tough place right now because in order to get an agreement through, Speaker Johnson is going to need Democrats to vote for this if the House Freedom Caucus members are not going to go for it. And the Democrats already agreed with Speaker Johnson on a bill that then President-elect Donald Trump said he doesn't want to see go through. So Speaker Johnson is in a really tough place. And of course, all of this is coming right ahead of the holidays.
Anne-Marie, we've seen the pictures. So the previous bill was this fat, and now the new one is about this fat. What got taken out of it?
Well, a lot of extras got taken out of it. There still was some disaster funding, but things like an increase for a pay rise for lawmakers was taken out. But more interesting, Jonathan, what was added? An extension of the debt ceiling, which is why you have Representative Chip Roy, a hardcore conservative, saying, sure, it looks much tinier, but you're adding $5 trillion to the national debt by doing this. So that is why you had these 38 Republican members come out and defy their speaker and President-elect Trump.
Anne-Marie, what's the takeaway in terms of the negotiating style of Trump and Elon Musk as head of Doge when it comes to where the eliminations will happen? That same Congress member also said that it would increase the deficit by $5 trillion. Is that true? Is that what we're seeing?
Well, when it comes to Elon Musk, what we're seeing him is wield his own platform, X, to put a ton of pressure, not just him alone, but also ramping up pressure from conservatives alike on this platform to put pressure on their lawmakers to vote against the bipartisan agreement Johnson got done. Elon Musk, though, was just here in Washington, D.C. with Vivek Ramaswamy, talking to Republicans about Doge and ways they can decide that they are going to cut spending. The issue, of course, is this is just supposed to be, yes, some extras were added into it, but it's just supposed to get them through March. So many Republicans felt like we can get through March, and then in March we can start enacting our agenda. It doesn't look like they're going to be able to get through 2025.
Meanwhile, Anne-Marie, a lot of people are looking to go away. This was supposed to be a quiet end to the year. A lot of people are going away for the holidays. What does this mean for travel?
It's a great question. The TSA administrator tweeted yesterday that this could have impacts on Americans who are traveling for holidays. They say that TSA, part of DHS, about 59,000 of the agency's 62,000 employees are considered essential. So the majority of their workers are essential, and they'll continue to come to work, but they will not get paid. So you have these people going to work, they're not going to get paid ahead of the Christmas holidays. And then the TSA administrator went on to say, while personnel prepared to handle high volumes of travelers and ensure safe travel, please be aware that an extended shutdown could mean longer wait times at airports. that is really going to get the backs up of most Americans.
Anne-Marie, we have a president. I've got to finish here. Where is he?
Well, I think, you could just say crickets. He's pretty much absent when it comes to this debate. I asked Doug Redeker that question in the last hour, and he said, well, which president are you talking about? And I asked him, why is Biden not getting involved in this? And he says, Biden just doesn't have the political capital right now to do so. We have yet to hear from President Joe Biden yet, and we are going into the holidays, and potentially the government is going to be shutting down, which means employees will not get paid. We've only heard from Karine Jean-Pierre, his press secretary, who said Republicans need to stop playing politics, and they said they should keep their word, a deal is a deal.
I get that these transitions, Anne-Marie, can be awkward, but this seems very awkward. There seems something very unique about this transition at the moment and the absence of the president. And it feels like also that people are actually starting to begin to speak their mind in a way where they perhaps should have several years prior. Are we starting to see more and more people come out and talk about how absent the president has been, not just over the last few weeks, but over the last 4 years?
Absolutely. There was really a damaging report yesterday in the Wall Street Journal about how absent, how in and out the president has been, and how the team around him have changed and shifted his schedule to make sure he was able to carry out his duties as president and commander-in-chief. And I think you're just going to hear a lot more of these stories going forward.
Honestly, Anne-Marie, this is something that's really a rising concern at a time where we can't necessarily get anything through. I want to finish on the idea of Donald Trump hoping to get rid of the debt ceiling limit, this idea that a lot of Democrats have been talking about. I'm just wondering, at what point do you see this as being plausible, given the fact that this shenanigan causes everyone to roll their eyes and most people would like to see it end?
I think a lot of people would like to see it, and Doug Redeker said himself he would love to see it. It's a pretty awkward day in Washington when President-elect Donald Trump and Elizabeth Warren are lining up on the same issue, and she tweeted that she agrees with Trump that they should just abolish the debt ceiling. The issue is, if Trump wants to get this done in his next 4 years, he would need Democrats to vote alongside with him. So he's going to have to give them something for that, and that likely would be some sort of spending measure that they're looking for. So potentially it could happen. You can never say never, but it would require a serious negotiation, and the Democrats would have just some leverage going into that.
Anne-Marie, appreciate your time. We'll catch up with you later. AMH down in Washington, D.C. It's going to be difficult to get things done in Washington. Whether you have a red sweep or not, it's hard to get things done.
Which raises this question about whether the hopes that people have and have baked into a lot of the optimistic outlooks for next year are warranted, right? Whether they've all been sort of prematurely baked in and now we get down to sequencing and we can actually get through Congress. I do think this is important so that we can figure out whether this is a healthy sell-off, a welcome sell-off, one that is refreshing, or whether it's one that highlights the perilousness of how far this market has gone on just a handful of names.
It's healthy if you haven't been in it. It always is, right?
Well, it's healthy if you haven't been in it, or if you've been looking for. Yeah, exactly. That's exactly it. People want to know.
Super healthy from that perspective. If you've been riding high all year, less so. We're down by a little more than 1% on the S&P 500. Up next on this program, do not miss this: the San Francisco Fed President Mary Daly on the fight against inflation and the outlook for 2025. Lisa, the Fed speak begins in about 4 minutes' time.
And this time around, it is probably the most important it's been in a long time as we seek to clarify what the different tests are that different Fed members have to evaluate whether policy is restrictive, whether they need to cut again, or whether they have to start thinking about even a hike.
20 minutes with the San Francisco Fed President Mary Daly just around the corner. From New York, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The opening bell 2 hours away. Equity futures on the S&P 500 session lows. 3-day losing streak into Friday. It looks like day 4, guys. We're down by more than 1% on the S&P. On the Nasdaq, we're down by 1.6. On the Russell, by about 1.2. With some movers. Your morning movers is Manus Cranny. Good morning, Manus.
Jonathan, good morning. Yeah, that looks a little bit more brutal as we go into the close of business. Novo Nordisk. If you want to understand what happens when you have a new experimental drug, and it doesn't hit the benchmark of what you told the market you were going to do in terms of weight loss, you lose around 22.7% if you use CagriSema. That is their new experimental weight loss drug. But the benchmark, Jonathan, the benchmark was up here at 25. So if that's what you told the market that this drug would deliver, you wipe out $120 billion worth of market equity in one fell swoop, down by $120 billion at one juncture. This is about market share, fending off Eli Lilly against you. This whole family of drugs is going to be worth $120, $130 billion by the end of the decade. So it's about defending the moat around your product range. Nike, the ghost of John Donahoe lives over Nike. This is FedEx. We'll come to Nike in just a moment. My apologies. Divide and monetize. You've got FedEx ready to hive off the freight unit. We reckon it's worth $38 billion. That's according to Bloomberg Intelligence. But the canary in the coal mine, even though we're up 5.5%, that's on the monetization of breaking off that piece of the business. Weak demand here in the United States of America in the express business. How do we get to Nike and the ghost of John Donahoe? This is what we've got for you, down 7.6%, because Elliott Hill has come in as a new CEO. He's missed his Adidas moment, which is just tank everything. Just get rid of all of the stock. Draw such clear blue water between you and the former CEO. That's what the Bloomberg opinion column are talking about. And the guidance here for Nike, low double digits. So Elliott Hill didn't take his opportunity to just tank everything that he has out there in terms of stock. He has gone on a world tour to mend the fences with the wholesalers. Not enough today.
Donahoe's getting a hard time. Still, Nike's down by 7.8%. Thank you, Manus. Appreciate it. More from Manus in the next hour. Under surveillance this morning, lawmakers on Capitol Hill rejecting a funding deal backed by President-elect Donald Trump. The U.S. government on pace to shut down at midnight tonight. A group of Republicans voting alongside Democrats saying they will not suspend the nation's debt limit until 2027.
The point here and the headline here is that 38 Republicans voted against this bill. So if people were looking for cohesion under the leadership of Donald Trump, that is not becoming evident. It really speaks to a messy year next year in terms of how fast certain policies can really get through.
Never mind a messy year next year. Messy finish to this year.
Well,
it's not where a lot of people want it to be, is it?
I did not want to hear what Anne-Marie had to say. Anne-Marie, take it back. that some of the air traffic controllers, not the air traffic controllers, the TSA members are going to potentially not be getting paid.
I know.
Which could slow getting through the airport if this goes on too long. That is a crisis.
As soon as you've got some skin in the game, you start to care a whole lot more, don't you?
Okay, well,
I know, it's real. Let's turn to this story. U.S. diplomats meeting with rebel factions now in power in Syria. Those meetings include talks with the group HTS, which is officially labeled a terrorist organization by the United States and other countries. The meetings coming after the overthrow of longtime leader Bashar al-Assad. Elsewhere, shares of FedEx rising in the pre-market. The shipper announcing a plan to spin off its $30 billion freight unit. Executives saying this will allow FedEx to focus on its core businesses of express and ground shipping. Analysts expecting the spin-off could unlock $20 billion in shareholder value. That stock is up in a pre-market by more than 6%. Turning to the Federal Reserve, cutting interest rates by another 25 basis points this month, but signaling the path is unclear for 2025. Fed Chair Jay Powell saying he feels good about the economy, but we are in a new phase in the fight against inflation. I'm pleased to say that joining us around the table, alongside Mike McKee and us, is the San Francisco Fed President, Mary Daly. President Daly, it's good to see you.
Nice to see you.
Thank you for giving us some time. Let's start with the forecast. Some controversy around the forecast. I'll go through the controversy. We don't speculate, we don't assume, we don't guess, and then a month later it felt like there was some speculation and some guessing about policy next year. I just want to talk about your approach to the forecast. Was it about the data for you, or was it about the incoming administration?
It's about the data. It's always about the data for me. We don't know what the incoming administration is going to do. You know, new administrations, no matter when they come, always put a slate of programs together, and really as a policymaker, I want to see the net effects once I see clarity about what those policies will be. So I was focused on the incoming information and what it means for the outlook. And today I feel like we've got policy in a good place, the economy's in a good place, and we're prepared for whatever comes before us.
What happened in the past 3 months that caused the Fed and perhaps yourself to be much more concerned about the stickiness in inflation?
Well, the data happened, and you look at the data, and what's happened is that, you know, there's two things that have occurred. First of all, the economy remains in a good place, and the risks to the outlook are equally balanced between a risk to inflation or a risk to employment. That's where we wanted our goals to be. And we adjusted policy when we had confidence that inflation was heading down, and we adjusted policy some more to ensure that we have a balanced labor market that continues. So that's where we are. But then the data on inflation have been coming in a little slower. I wouldn't even say sticky or stalled. I would say the progress has just slowed relative to what we had wanted. But that's a typical pattern. It's bumpy. As you get to the, you know, from 2.5 or 2.8 to 2, it's just a bumpy path. Yeah, go ahead, please.
But at the same time, some people were wondering if there was this stickiness, and I'm looking right now at, say, the Cleveland CPI now, and it actually has ticked up for the month of December from November. There was this question, why did the Fed cut it all?
Sure, and again, I'm going to reassert that it's bumpy. You know, remember earlier in the year, we had 2 months of data and people said, oh my gosh, it's reaccelerating, and then we had it come down. So inflation data, you can't focus on 1 month or 2 months. The most important thing for me was that we needed to recalibrate policy. I saw this as a close call. You know, was 75 enough to be the recalibration we were looking for, right-sized policy to meet the economy we expect, or do we need more? Ultimately, I determined that the 100 basis points was really the right level. Now I feel we've got that recalibration phase behind us, and we're in the next phase. And the next phase is really looking at the incoming information. We can return to a more typical pattern of gradualism for the Fed. You know, we've practiced that where you, with a lot of uncertainty, you adjust the policy rate, then you wait watchfully, and you see what transpires, and then you make further adjustments. That's the phase I think we're now entering.
From September, the expectation in the markets was going into every meeting that you'd be cutting. Has that changed now? Should the expectation be that you won't be doing anything at any particular meeting? And from that question flows a second question. What are the criteria that you need to see to decide to go back to cutting rates?
Well, as you saw from the SEP, the median projection is 2 rate cuts next year. So that's already not every meeting or every other meeting. That's 2 rate cuts. I was very comfortable with that median. That makes sense to me. But we have to remain agile. I mean, you know, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. You know, the world is uncertain, so we pencil in 2, and, you know, as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it, and every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking, what's the right level of policy? But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front and saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now,
Absolutely.
at least coming out of Chairman Powell's press conference, it sounds like the focus has shifted to inflation again. Are you comfortable with that as this new phase that he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case, but I see policy as already in that position where it's supporting both. The policy is restrictive. It's going to continue to bring inflation down, and it's going to do so in a way that doesn't strangle the labor market, break it, and then give people lower inflation, but take their jobs. And that's not what we're trying to do. We're really working towards that soft landing.
Mary, you've used the word "we" a lot when you talk about what's happening at the Federal Reserve. We've had some people who are quite critical of the Federal Reserve and Chairman Powell's performance specifically in this news conference. One excuse that was given was that maybe he was struggling to reflect the lack of a consensus on the committee. How much diversity of thought, disagreement is there on the committee? You called it a close call for yourself. But was there some disagreement on the committee at this meeting?
Well, I'm not going to speak about the entire committee. When I say we, I stay focused on the things we all agree on, which is price stability and full employment, on our efforts to get there. What I would offer is that we have, in my mind, the healthy level of discussion and disagreement. You don't want an FOMC that thinks exactly alike. And I believe that what people are looking at is the fact that now the world is more uncertain and people are debating and bringing in their views, and that's appropriate. When it was a pandemic and there was only one direction to move interest rates, we had to do it quickly, it was obvious everyone agreed. When inflation's high, there was no disagreement, right? We're all marching up. Now you should expect more disagreement, more differences of opinion, but they're always framed to the same thing. How do we get inflation to 2 and restore or keep full employment?
When I hear the world is more uncertain, a lot of people hear, well, that's not about the data, that's about the incoming administration.
I would disagree.
Why would you disagree?
Because we have a variety of risks that are the ones we always deal with, right? The housing inflation. Right now, there's a substantial housing imbalance in the United States. The models in our data and our past experience all say housing inflation will come down, but we are uncertain about that, right? It hasn't come down as quickly as the models would have predicted, and so that's an issue. The labor market and consumer spending and growth are much faster and stronger than people would have predicted at this point, given the tightening we've done. There's a lot of uncertainty about the natural rate of interest. Where's the stopping point? And then, of course, there's geopolitical risks, the risk to global growth. That's going to be the backdrop, and then you have a change in administration. So I would say this level of uncertainty is normal in the sense that we've had all those things going on, and it's not as excessive uncertainty as after the pandemic, the financial crisis. Those were really big periods of uncertainty. So I think if you're a central banker, you just get used to uncertainty and you manage it.
Before we get into what some of the uncertainty about next year could look like, I am curious about how you're weighing how to preserve the job gains with the risk of running the economy hot for too long. And that's, I think, something people are struggling with. Is there an emphasis on the labor market, even at the behest of inflation, just because it's been deemed better for inflation to be a little hotter as long as people keep their jobs?
Yeah, I would characterize it a little differently, but that is a terrific question. And it's one we spend, as you know, Reserve Bank presidents spend a lot of time in the field, working in our district. I have the whole Western United States. And so I asked people the question, where are you on this? And again, I hear that the economy is sort of in a good place, right? Inflation's coming down, it's gradual, and the labor market is solid, but there's one job for every unemployed worker. You know, that's in perfect balance. And our firms are saying we can find workers, and our workers are saying we can find jobs. And no one really wants that to break. So what people do not want is a recession. And I think one of the reasons sentiment's been rising since the middle of this year is because the recession risk is now behind us in people's minds, and they feel good about that. So what I hear more than you would think is don't get 1/10 off inflation and then break the economy. That's like, we can be patient, but you just have to head for 2, and we don't want the economy to break.
That's why I thought it was interesting that the inflation forecast for next year was shifted upward, even at a time where the unemployment rate was shifted downward. There was a sense that that was okay to have 2.5% inflation at the end of next year, even though it was above 2%. Is that the sort of feeling right now on the Fed, to be more patient with inflation because it's thought of as less punitive at a level below 3% than, say, a rise in unemployment?
Well, let me just say how I think about it, because here I will speak for myself. I'm not comfortable with the rate of inflation being 2.5, but we're continuing to work on it. And so we might end up cutting rates, cutting rates less if inflation is as sticky as that. But what I'm also balancing is I don't want to see an unnecessary rise in the unemployment rate just to get a quarter ahead on the 2% goal. So that is a balancing act, and I think ultimately we were just looking at the information coming in and saying, you know, there's a lot of risks out there. Inflation could rise, but you'll see, you know, the inflation rising was partly why you saw the rate cuts pulling back. Is if we had 4, you'd see inflation go up more, and so this is a balancing act. But I think it also points you to the dispersion that you saw in the SEP, which I see as a feature, not a bug. You should have some dispersion when the world's uncertain. Otherwise, you would wonder if we're all in an echo chamber, but we're not. You can see that clearly, and you see the dispersion. And I think that dispersion really represents what we're facing. We might end up with fewer cuts than 2. We might have to respond and end up with more if inflation falls faster or you see a significant weakening in the labor market. And I'm comfortable sitting in that center court position and waiting for the data to come in, and we'll agilely respond as they do.
Well, do you think there's any chance that you might have to raise rates next year?
You know, I don't see that on the horizon right now, but we will always remain prepared to do what is needed to achieve our goals. But I don't see that in the span of the most salient risks right now that I face. But, you know, absolutely, that's something that we never take off the table.
Who owns the dot with no cuts next year? Come on, reveal. Whose is that in 2025?
Reveal.
Not going to tell us.
No, I'm not going to tell you. I'm no rookie, you know. I'm rookie.
Just seeing how far I can
It's not
push
a
you.
holiday gift I'm willing to give you.
All right, I'm just checking.
Reveal. That was subtle.
President Daly's going to stick with us, I'm pleased to say. Thank you. Mike McKee, thank you as well, sir. The San Francisco Fed President, Mary Daly. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Tensions are building between Amazon and the International Brotherhood of Teamsters. The union called on thousands of Amazon workers to walk off the job yesterday and is now warning more Amazon workers would go out on strike in the near future, just ahead of the holiday delivery rush. In response, Amazon says it's filed unfair labor practice charges against the union. Meanwhile, U.S. Steel shares are falling nearly 6% in the pre-market. The company warning its fourth quarter earnings will be lower than expected as steel prices remain depressed. It anticipates adjusted earnings before items of about $150 million, falling significantly short of the over $260 million Wall Street expected. Wall Street analysts are taking this opportunity to say this underscores why a deal with Nippon Steel would be beneficial. And iPhone maker Foxconn is putting its interest in Nissan on hold while the Japanese automaker continues merger talks with Honda. Former Nissan chairman Carlos Ghosn tells Bloomberg what Nissan's potential merger with Honda means for the struggling automaker.
They have cash problem, they have investment problems, they're being really hammered in the United States, they got practically out of Europe, they're being challenged in China, and there is no plan in front of it. So I can tell you that means there is panic mode inside Nissan.
Excellent interview. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, weighing policy uncertainty.
Some people did take a very preliminary step and start to incorporate
highly conditional estimates of economic effects of policies into their forecasts at this meeting.
We'll dig into that next on the program, live from New York City. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never.
Ready?
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to the program, live from New York. Equities at the moment on the S&P attempted to bounce off session lows. We're still down by 0.9%. Under surveillance this morning, weighing policy uncertainty.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
So that was Fed Chair Jay Powell admitting multiple FOMC members weighed policy uncertainty in their economic forecast. The San Francisco Fed President Mary Daly is still with us. President Daly, you were all about the data, not about the administration change. We do want to talk to you about how you would approach changes in policies from the incoming administration, though, across many dimensions: immigration, taxes, but the big one, I think, for many, tariffs. What's your approach going to be next year?
So we have all the tools and evidence from past historical periods. We can think about how these things will affect the economy. You know, one of our biggest tools of figuring out how things will affect the economy is talking to CEOs of small, medium, and large companies, and we've already been engaged in doing that. So when we're out there in the field talking to people from across the country, and I'm spending my time in the 12th district, we're hearing that they're their sentiment is up. They're really optimistic that they've been cautiously optimistic. They see the Fed's interest rate path falling, and they feel good about that. They see the economy as the recession risk is behind us, and they feel positive in general about some of the things that they think may change going forward. Now, whether that materializes or not, we will wait and see, but I feel that sentiment alone is causing us to have some enthusiasm, some cautious enthusiasm, if you will. One thing that we hear is that for firms that are worried about the immediate impacts of tariffs on their business, they're just building up some inventory so that they can have some insurance. And so that's something you'll start to see in the data already. But I haven't seen that in such an outsized way that I think it's going to change the course of the economy.
One thing that you say, President Daley, is that we have experience from the past of tariffs, of some of the immigration bans or limits. But is this time more difficult just because of where we're coming from? It is a more inflationary time after a pretty big stimulus package injected into the economy.
You're feeling like an economist, like when you think of state dependence, right? The impacts of policies are affected by the state of the economy. So one thing that is on my mind is that we already have inflation above 2%. And so we have to work hard to get inflation down to 2%. And that is an economy that's just a little more vulnerable than it would be if we had inflation, at 2%, or when we came in to the tariff discussion or trade discussions last time, it was below 2%. So I feel on the other side, the real side of the economy is very strong or solid. And so we're in a good position, but it is on my mind that inflation's already elevated.
Well, does that make it that tariffs are more likely to be inflationary than they have been in the past?
It's really hard to say. I mean, one of the things you learn from doing this kind of a job a while is that it really depends on the scope, magnitude, timing of tariffs, and whether our companies in the United States are positioned to use substitutes and manage. And you see this happening. We already went through another feature that might make it less challenging is that in the pandemic, firms reshored, nearshored, friendshored, and you saw a lot of that behavior already taking place. So we'll see.
We just have about a minute, but in being agile, how concerned are you that people are going to label decisions as political?
I don't feel concerned about that. I think what we've done well is talk to the American people. The chair does that in his meetings. We do that. And we're telling them we are only focused on inflation and full employment. Those are the goals Congress gave us. We're going to do our best to navigate the incoming information, whatever causes it, and make the good decisions, make the best decisions, and then be humble about having made the wrong one or the right one and redo it. And think about it again. So that's how we're going to approach it. And I think ultimately people will judge us by whether we're successful.
You've been generous with your time this morning. We appreciate it. Enjoy the holidays.
Happy
Thanks
holidays.
for being with us. Thank you.
Bye-bye.
That was Mary Daly there, the San Francisco Fed president. We will look at the politics. Donald Trump, the incoming president, on Truth Social. If there is going to be a shutdown, let it begin now. That's the message from the incoming president. We'll catch up with Anne-Marie in the next hour, so look out for that. Also joining us coming up on the program in the third hour of Bloomberg Surveillance, we'll speak to Matt Miskin of John Hancock, Zachary Waring of CFRA, the brilliant Kathy Bosjancic of Nationwide, and Sabajari Shapa of SocGen. The third hour up next.
We're going to be talking about the Bank of England, what they're doing, and maybe more importantly, what they might be doing next year with interest rates in 2025.
Yeah, it's like the Bank of England is trying to send us a message, but it's like written in a different language or something. It's not quite clear what they're trying to tell us. The markets are saying one thing, but the bank might be thinking something else.
Yeah, and the thing is, they just decided to keep the bank rate right where it is at 4.75%. And, at first glance, you might think, oh, well, that's not very exciting, is it?
Mm-hmm.
But the markets were actually expecting maybe like 2 rate cuts next year. And then the Bank of England governor, Andrew Bailey, kind of threw everyone a curveball. He came out and said that maybe 4 quarter-point cuts in 2025 might be more appropriate. It's like, well, hold on a second. What's going on here?
Oh, right. Yeah, it seems like everyone's on a different page. And then to make things even more interesting, it looks like 3 members of the Monetary Policy Committee actually voted against keeping the rates the same. They actually wanted to cut rates right now.
3 of them, huh? So who are these 3 and what's their deal?
Well, you got Dhingra, Ramsden, and Taylor. Ramsden has been pretty vocal for a while now, saying that he wants to cut rates. He thinks the economy needs a little help and that cutting rates is the way to do it. Dhingra is more worried about how high inflation is hurting people, especially those who don't have a lot of money. She thinks that cutting rates could give some people a break. And Taylor, well, he's got a slightly different angle. He's more focused on the possibility that the economy might slow down, and he sees cutting rates as a way to kind of give things a little push and keep things moving. But the fact that all three of them disagreed with the decision to keep rates steady, well, that tells you that there's some real debate going on inside the MPC about what the best move is.
Okay, so it's like got this kind of internal battle going on at the Bank of England. You got the folks who are saying, hey, let's be careful and take it slow. And then you got others who are saying, no, we need to do something now. And it kind of makes you wonder who's got the right idea. Are they being too cautious, or are the ones who want to cut rates jumping the gun?
That's a great question. And to try and answer that, the article we're looking at brings in a few experts. They try to weigh in on this whole debate, like Stefan Koopman from Rabobank. He thinks the markets are totally off base. He thinks the MPC is actually getting ready to cut rates way faster than anyone is expecting.
So he's on the side of let's cut them faster, huh?
Exactly. And he's not the only one. Konstantinos Vanettis from TS Lombard seems to agree with him. He's even using phrases like deeper rate cutting cycle, which makes you think that maybe this is going to be a bigger change than we thought at first.
Okay, so faster and deeper cuts. Got it.
Yeah.
But here's the thing I'm wondering about. When are these cuts going to happen? Are we talking about a big sudden change or more of a gradual thing?
Yeah, that's where it gets even more interesting. Sanjay Raja, he's a UK economist at Deutsche Bank. Well, he's also predicting 4 cuts next year, but he thinks they'll mostly happen in the second half of the year, kind of like waiting till the end to make the big move.
Ah, so a backloaded approach. That's like waiting for the perfect moment. Right? But why wait?
Well, he thinks the Bank of England is playing it smart. Like they're saying, let's just see how things go and then we'll make a move. They're waiting for certain signs from the economy before they really start cutting rates.
Okay, that makes sense. So what are these signs that they're looking for? What's going to tell them that it's time to start chopping those rates?
Well, Raja specifically mentions things like unemployment going up over 4 or 5%, and wage settlements cooling down, meaning that wages aren't growing as fast anymore. And services inflation coming down too. It's almost like they have this checklist, and once they check off all the boxes, then they'll feel good about cutting rates faster.
So it sounds like a slow start to the year, and then maybe things pick up speed in the second half. But it's not just about the timing, is it? It feels like they're trying to do 2 things at once. They want to help the economy grow, but they also don't want to mess things up. It's kind of like they're walking a tightrope.
Yeah, exactly. It's a tough balancing act for sure. On one hand, they want to loosen things up a bit and give the economy a little boost, but they're also worried about spooking the markets or accidentally causing problems. It's like trying to steer a giant ship. You can't just make sudden turns. You got to be careful and make changes gradually.
It's funny you should say that, because I was just thinking about how this affects us. You know, regular people just trying to manage their money. I mean, we're not the ones setting interest rates. But all these decisions from the Bank of England can have a real impact on us, like our mortgages, our investments, all that stuff.
Oh, absolutely. And that's why it's so important to understand what these potential rate cuts could mean for you and your finances.
Okay, so let's get practical here. If the Bank of England does decide to speed things up in the second half of 2025, what could happen? What should we be watching out for?
Well, one thing that could see some big changes is the housing market. Lower interest rates usually make mortgages easier to afford, and that can lead to more people wanting to buy houses, which could push prices up. So if you're thinking about buying a home, these rate cuts could be a big deal.
But hold on, wouldn't that also mean that housing could become even less affordable for some people? Like the ones who are already having trouble getting into the market. Wouldn't that just make the gap between homeowners and renters even bigger?
Yeah, that's a good point. It's kind of a two-sided coin.
It could help some people get into the market, but it could also make things harder for others.
And we might even see people start buying houses just to try and make money quickly, which could create a bubble that eventually bursts. Definitely something to keep an eye on.
Okay, so good news for some buyers, maybe not so good for others. Sounds like a mixed bag for the housing market. What about investments? How could these rate cuts affect things like stocks and bonds?
Well, historically, when interest rates go down, stocks tend to look more appealing to investors. That's because when rates are low, investors start looking for other places to get higher returns, and the stock market often seems like a good option. So we might see certain sectors do really well after these cuts, especially the ones that are sensitive to changes in interest rates.
So does that mean people should start moving their investments around?
Well, it's not quite that simple. Remember, investing always has risks. And we got to keep in mind that the Bank of England is making these decisions based on what they think is best for the UK economy. but that's just one part of the whole picture. Things happening around the world, unexpected events, all sorts of stuff can throw things off.
Right. It's like trying to predict the weather. You can look at the forecast, but you never know when a storm might pop up.
Exactly. So, yeah, while these potential rate cuts might create some good opportunities, it's super important to stay informed, do your research, and understand the risks. Don't just jump into anything without thinking it through just because you hear interest rates might be going down.
So stay alert, do your homework, and don't put all your eggs in one basket.
Got it.
But sometimes I think we get so caught up in all the numbers and predictions that we forget about the people involved. These economic decisions have real impacts on people's lives, on their hopes, their worries, their ability to just make ends meet.
You're absolutely right. And that's what makes this whole discussion so interesting and honestly a little bit scary, too. We're talking about real people's livelihoods here.
I mean, imagine you're a young couple trying to save up for down payment on your first house. These rate cuts could be amazing, or they could be a total disaster. It all depends on how the market reacts. Or think about someone who's close to retirement and counting on their investments to give them a steady income. These changes could have a huge impact on their financial security.
Yeah, that's a really important point. It reminds us that this isn't just about abstract economic ideas. These decisions have real consequences for people and families all over the UK.
Exactly. So as we're trying to figure out this whole economic situation, it's important to remember that there are real people behind all these numbers. Their stories, their hopes, their struggles, they're all connected to these economic forces. And even though we can't predict the future for sure, we can at least try to understand what might happen because of these decisions, and then make smart choices that work for us and our goals.
It's kind of like trying to walk that fine line, you know? Keep everyone happy, but not make any sudden moves.
Yeah, it makes you think about how all of this connects back to us. You know, regular folks trying to manage our own money. We're not setting interest rates or anything. But these decisions from the Bank of England, they can really affect us. Everything from our mortgages to our investments.
Absolutely. And that's why it's important to try and understand what these potential rate cuts could actually mean for your own personal finances.
Okay, so let's get down to it. If the Bank of England does decide to speed things up with those cuts later in 2025, what could happen? What should we be looking out for?
Well, one area that could see a lot of action is the housing market. Usually when interest rates go down, mortgages get a little easier to afford. And that can lead to more people wanting to buy houses, which could push prices up. So if you're thinking about buying a home, these rate cuts could be pretty important.
But wait a minute, wouldn't that also mean that housing could actually become less affordable for some people? Especially those who are already struggling to get into the market. Wouldn't it just make that gap between homeowners and renters even wider?
Yeah, that's a valid point. It's kind of a double-edged sword, you know? Lower rates could help some folks get into the market, but it could also make it even tougher for others. And we could even see people start buying up houses just to try and make a quick profit. That could create a bubble, and we all know what happens when bubbles burst. Definitely something to pay attention to.
Okay, so good news for some buyers, maybe not so good for others. Kind of sounds like the housing market could be a bit of a roller coaster. Now, what about investments? How could these rate cuts affect things like stocks and bonds?
Well, historically, when interest rates go down, stocks tend to become more attractive. Investors start looking for places to get better returns, and the stock market often seems like a good bet. So we might see certain sectors do particularly well after these cuts, especially the ones that are really sensitive to changes in interest rates.
So is this a sign that people should be thinking about changing their investments?
Well, hold on a sec. It's not that simple. Gotta remember that investing always comes with some risk, and the Bank of England is making these decisions based on their view of the UK economy. But that's just one piece of the puzzle. There are things happening all over the world. Unexpected events could pop up and throw things off.
Right, it's like trying to predict the weather. You can check the forecast, but you never really know when a storm might roll in.
Exactly. So while these rate cuts could create some good opportunities, it's really important to stay informed. Do your research and understand the risks involved. Don't just jump into anything without thinking it through, just because you hear that interest rates might be going down.
Okay, so stay informed, do your homework, and don't put all your eggs in one basket. Got it. But you know, sometimes I feel like we get so focused on all the numbers and forecasts that we forget about the human side of things. These economic decisions have real consequences for people on their hopes, their anxieties, their ability to simply get by.
You're absolutely right. It's what makes this whole topic so fascinating and honestly a little bit unnerving too. We're talking about people's lives here.
I mean, imagine you're a young couple trying to save up enough money for a down payment on a house. These rate cuts could be a huge help, or they could really throw a wrench in your plans. It all depends on how the market reacts. Or think about someone getting close to retirement relying on their investments to provide a steady income. These changes could have a big impact on their financial security.
That's such an important point. It reminds us that these aren't just abstract economic theories. These decisions have tangible consequences for real people and families all across the UK.
Absolutely. So as we try to make sense of this complex economic situation, it's crucial to remember that there are real people behind all the numbers. Their stories, their hopes, their struggles, they're all interwoven with these economic forces. And while we can't predict the future with absolute certainty, we can at least try to understand the potential consequences of these decisions and make informed choices that align with our own values and goals.
Yeah, it really makes you think, doesn't it? It's like we've got this puzzle with all these moving parts. The Bank of England's trying to find that sweet spot between boosting the economy and keeping things stable. Experts are making predictions that could send the housing market through the roof or leave some buyers high and dry. And then there's all of us just trying to figure out how to manage our money with all this uncertainty going on.
It's definitely a complex situation, but that's why we're here, right? To try and shed some light on things and help you, the listener, make smarter decisions. Exactly. So as we wrap things up, is there one key takeaway that you want our listeners to remember? What's the one thing they should keep in mind as they try to navigate all of this?
Well, I think the most important thing is that this situation is always changing. The Bank of England has given us an idea of what they might do, but things could easily change. The market might be underestimating how quickly and drastically the bank might act, and that could have a big impact on everyone.
So it's not just about whether they'll cut rates, it's also about how fast they'll do it and by how much.
Exactly. And those factors could ripple out and affect all sorts of things, from house prices to how people invest their money. It's like a chain reaction, one move leads to another. But it's important to remember that nothing is set in stone. There are lots of things that could happen and things can change quickly.
So we're talking about possibilities, not guarantees.
Right.
So what would you say to our listeners? How can they stay ahead of the game and make sure they're ready for whatever comes next?
Well, first of all, stay curious. Keep an eye on those economic indicators we talked about, like unemployment wages and inflation. Those are the things that will give you clues about what the Bank of England might do next. And don't just rely on headlines, dig a little deeper. Try to understand why these decisions are being made.
It's like being an economic detective, looking for those little clues that tell you what's really going on.
Precisely. And maybe most importantly, think about how these potential changes could create opportunities or risks for your own personal finances. Are you thinking about buying a house in the next year or two? Are you investing for retirement? The decisions the Bank of England makes could have a real impact on your goals. So take some time to consider how these changes might affect you personally and adjust your plans if you need to.
It's all about being proactive, taking control of your financial future instead of just reacting to whatever happens.
That's the idea. Knowledge is power. The more you understand about these economic forces, the better equipped you'll be to make informed decisions that work for you.
Well said. This has been a really insightful deep dive. Thanks so much for helping us navigate these choppy economic waters.
It's been my pleasure. I always enjoy exploring these topics, and I applaud our listeners for taking the time to stay informed.
And to our listeners, we encourage you to stay tuned for future deep dives as this story continues to unfold. The economic landscape is always changing, and we'll be here to help you navigate it every step of the way. Until next time, stay curious, stay informed, and stay ahead of the curve.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Really has held in well. We are seeing high yield spreads, though, start to rise. So we've seen about 20 basis points rise in high yield spreads. That is, to us, the music, if you will, playing in the background. We don't want to turn up the volume into next year and go more into credit markets. So we're managing that risk. We still have intermediate duration with a mild credit bias, but not really reaching more for credit. The other thing to use is the dollar, and I really like the dollar as another hedge. So when rates are rising, that's going to help raise the dollar. These tariffs we keep hearing about, that's actually usually dollar positive as well. So either bonds or the dollar usually work out for you if equity risk is coming into play. So we've got a dollar overweight expressed across all our views. That's helping here, even though the rate side, it's been harder to use that as a hedge. But I think in the next year, again, one of the biggest things we're seeing is housing is starting to slow. Inventory starting to rise. The biggest inflation concern over time has been housing. If that moderates, inflation comes down. Inflation expectations actually haven't risen that much, another thing. So don't give up on bonds as a hedge or return capital appreciation vehicle into next year. We're going to get about 5% plus in income. That's a great starting point. But we're using the dollar short term as another way to hedge risk over the short term.
Matt, thanks for everything this year, buddy. Appreciate it. Happy Christmas. Matt Miskin there, John Hancock. Merry Christmas and a happy holidays to all of you. 50 minutes to go. Lisa, about 45 minutes to go before we wrap this thing up.
Yeah, I was just listening to Matt and talking about inflation expectations, and I'm thinking, I remember when we used to care about the University of Michigan 5 to 10 year inflation expectations, and guess what?
Hey, don't get loose and easy with we.
Oh, hold on a second. Absolutely not. You've got loose and easy this whole time about we caring about F1, but I will say that we are going to be getting the latest reading on that in just about an hour and I guess 45 minutes.
Okay, 10 a.m. Eastern time. Special coverage of you, Mitch, dropping with Lisa.
Okay, leave me alone.
No, not sticking around.
If you stick around to watch,
I am
I'll do
not
it.
sticking around for that. I am long gone. In the bond market right now, yields are down by 2 basis points. The 10-year 454. Equities are lower as well on the S&P 500, down by about 0.9%. Some big movers out there. Let's get you one. Here's an update on stories elsewhere with your Bloomberg Brief with Yahara Hacker. Say Yahara.
Hi, John. Shares of Novo Nordisk plunging nearly 20% in the pre-market, wiping out more than $100 billion of market cap in one of the most anticipated drug studies of the year. Novo's experimental weight loss drug, CagriSema, was expected to deliver 25% weight loss. Instead, patients lost only about 20% of their weight after 68 weeks. As a result, you're seeing the maker of Zepbound, Eli Lilly shares rise 6.7% in the pre-market. Meanwhile, Lockheed Martin is on track to meet its goal of delivering at least 100 F-35 jets to the U.S. military this year. This coming as the F-35 program has come under attack by Elon Musk, who thinks manned fighter jets are obsolete. Musk is advising President-elect Donald Trump on cost cutting, and the F-35 has a total $486 billion total acquisition price tag. And Apollo estimates the private credit market could reach $40 trillion within the next 5 years. In an interview with Bloomberg, Apollo's global head of credit product said the firm is seeing growth mostly on the investment grade side, as well as in assets like mortgages, which typically sit on bank balance sheets. And while some are staying away, they're eyeing opportunities in Europe, including in commercial real estate. That's your Bloomberg Brief. John?
Yahara, thank you. What a year for our friends over at Apollo. What a year. That stock up by more than 80% and a big move post-election.
You know, I have to wonder how much this has to do with Mark Rowan and the fact that he was rumored to be in the running for Treasury Secretary, whether that juiced their prospects.
You think? Just a little bit?
I don't know.
I don't know. I think this is the future of asset management.
I think that it could be
they're
combined.
Exactly where the puck was going at the right time.
I don't disagree, but you don't think that it added anything?
No.
Nothing?
No.
Okay.
Just my view. What's my view worth? What's my view worth?
A lot, John, a lot.
Nothing to anybody. Up next, the morning calls, plus the turnaround plans over at Nike. That stock is down by a little more than 6%. We'll get you a view on the other side of this commercial break. From New York, this is Bloomberg.
Middle East, and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Just got a message from a Bloomberg subscriber. It's that time of the season. Delighted to hear Happy Christmas on US TV. As an Irishman with an American other half, the Happy versus Merry Christmas debate is more ferocious than Fed rate cuts.
That's a good question.
Many of us say happy over in the UK.
Really? You say Happy Christmas?
Happy Christmas and not Merry.
Okay, in the US it's Merry Christmas and Happy Hanukkah because of the alliteration.
They
so
do,
that's
and the Happy Holidays thing.
the
just
Happy
to sort of
Holidays.
make it super generic.
It's just basically encompass everything.
Not to
Happy
offend
Kwanzaa.
anyone.
But right,
Okay.
so it's sort
Kwanzaa?
of this, all these are other holidays that are celebrated.
People celebrate that?
Yes, absolutely.
Okay, all right. I'm not going to offend anyone on my way out the door. Merry Christmas and a happy holiday to you all. Let's get you some morning calls. First up, Monness Crespi downgrading Oracle to sell, pointing to mounting competition and an unattractive valuation. That stock is down by 1.4%. Next up, JP Morgan raising its price target on FedEx to $370, saying its freight spin-off is not yet priced into shares. That stock is up by more than 7%. And finally, Tausi downgrading Nike to market perform, saying recent results point to a slower turnaround and limited clarity on inventory. That stock is down by 7.5%. Let's stick with Nike, the company reporting second quarter sales and profits exceeding estimates, but a sales slump weighing on its revenue forecast. Zachary Waring of CFRA maintaining a hold on Nike, but cutting its price target to 80. Zach joins us now for more. Zach, welcome to the program. How long is this turnaround effort going to take in your mind?
Yeah, thanks for having me. We do think it's going to take some time here. You know, the new CEO just got into Nike a couple of months ago. You know, we expect maybe an analyst day or an investors day sometime in the spring or early summer. But yeah, I mean, the guidance was pretty poor. You know, I don't think a lot of analysts or investors thought, gross margins would compress the way that they're guiding for in Q3. So, a little bit of a negative result here to earnings.
It feels like they're trying to go back to the foundation of the company, back to running, back to sports, get back to that and really focus things and narrow it down, and also try and repair what they ultimately damaged, which was some of the channels, including the likes of Foot Locker. How difficult will it be to go back to basics and repair some of those issues?
Yeah, it will be tough. I do think, they're doing a good job now kind of right-sizing inventory. They're working on, kind of limiting inventory for their classic sneakers. Running is doing, surprisingly well. I know a lot of people have talked about, competition from Hoka and On, but, running has been stable for them over the last few quarters. They're even seeing a little bit of growth, and they said they had some growth in women's this quarter. So, a lot of people were worried about On and Hoka and some of that competition. It's still a great company. It's still got, one of the best brands in the world. But they're going through a transition period, and it's going to take some time. So, we've lowered our price target to 80. We've been neutral to negative for a couple of years now. But I think, you're kind of turning a corner here. And I think over the next few quarters, there might be an opportunity to buy shares.
Zach, I have to say, every single day when we talk about Nike, we talk about basketball, and John says, well, isn't the basketball sort of sheen of cool kind of fading? And you see certainly the idea of what you have with viewership going down. And I make the argument maybe some of it's migrating to the WNBA. What's the real story here in terms of Nike's attachment to basketball and what seems to be flagging interest in the sport?
Yeah, and you've seen that, at their Jordan brand. This is, the first year that they've seen Jordan kind of decline over the past 5 or 6. So, I do think there is, an issue there, but I think they'll work through that. They've done a really good job of capitalizing on women's sports. They're usually a first mover there. And so, yeah, I mean, I think over time they'll be fine. I do think, in the near term, they're going to continue to see revenues decline in that category. But that's, he's focusing on sports and he thinks that's kind of the next leg of growth. I think the issue is now, you've seen China decline. They've been in China for a while. So, how much more growth can they get out of that region? And so it'll be interesting in the next, few quarters to see if they can turn that region around. And his, is his focus on sports going to pay off? They're in, plenty of sports, and they were first movers in a lot of them. So it'll be interesting to see if they can kind of return to growth here.
Is there anyone on your wish list for some of the big sports that they focus and they've arranged their teams into, which is basketball, football, and soccer? Is there anyone who you'd like to be sort of the front man or the front woman for their products who you think could actually make a real big difference? And I know this sounds kind of silly, but sometimes it takes one major star to completely turn around an entire brand.
Yeah, that's tough because they usually do have the biggest in each, in each sport. They've done a good job over the last 25, 30 years to kind of capitalize off of that. And they were obviously the leaders in doing that. So I don't think there's a one single person right now that could, turn things around for them. I think they've got, good strategy in that part of their business. This quarter their marketing expense was up 1% with revenues down 9%. So they're still spending on that side. So it'll be interesting to see over the next few quarters. It's going to be a tough turnaround for Elliott. I think, investors should probably stay patient here and wait for, a better opportunity when you can kind of see the light at the end of the tunnel.
Hey, Zach, appreciate your time. Enjoy the holidays, sir, and have a happy New Year. Thank you. Zachary Waring there of CFRA. Lisa, you're right. I think everyone's looking for that revolutionary athlete all the time. Jordan, basketball, Tiger, golf, Serena, tennis, the likes of Simone Biles, gymnastics. We've seen this on repeat over the years. It might be a struggle right now to find out who that person actually is at the moment.
Sometimes they get in early. It's not just the star that's been established, but you think about what Roger Federer did. You think about some of these other brands that have really grown up around specific athletes that were identified early. It sounds so minor compared with a major billion-dollar company that's dealing with tariffs and everything else, but that's kind of the influencer world that we're in, particularly when it comes to athletic wear.
They just got it so wrong. You and I have talked about this all the time. You walk around the city, go for a walk on the weekend, you see the about this all the time. You walk around the city, go for a walk on the weekend, you see the explosion of these running clubs. Running has absolutely exploded across this country. And then you just look at the sneakers that everyone's running in, and you do not see many Nike swooshes in a way that you used to.
And part of this is because those running clubs, what are the free handouts? I know this sounds silly, the gels and the things, but it's true. They're not there. They're not giving out their products and making, making a stand.
They haven't been in the game at all. Equity futures on the S&P down here by 0.8%. We'll get some economic data for you in just a moment and get the thoughts from Kathy Bosch-Jancic of Nationwide and Subhadra Rajappa of SocGen in just a moment from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bell and a few seconds away from some economic data in the United States of America. Core PCE, a preferred inflation gauge over at the Federal Reserve, and then a little bit later, some special coverage from Lisa at 10 a.m. Eastern Time when she breaks down the UMich consumer sentiment numbers a little bit later.
With hits also contributed by John Farrow, who's going to be joining at 10:30.
10:30?
Yes.
I'm staying an extra 30 minutes later.
Yes, that's correct. That's what's going to happen
I'm
if
not
I do the
doing
special.
Any of that.
We have data.
Equity futures right now in the S&P into this data down about 0.8%. With that data, here's Mike McKee. Good morning, Mike.
Good morning. It's coming out very slowly because I guess a lot of people are looking at this as the last number of the year that matters. And so it's taken a minute to come up, but here we go. Price index on a month-over-month basis up 0.1%, even less than forecast. The forecast was for 0.2, which was what we saw last month. On a year-over-year basis, headline 2.4%. That's up a tick from October, but not as bad as would be forecast. The core up just 0.1%, and the core year-over-year is up 2.8%, same as last month. No increase, even though an increase was expected. Personal income up 0.3 on the month, and personal spending up 0.4. That's a little bit less than anticipated, but does show people are still involved. This is an interesting number because Jay Powell gave us the numbers the other day, but economists didn't all buy into it. It's this most important number because it's the Fed's number for its target, and yet by the time we get to it, everybody kind of knows what it's going to be.
Well, it's breathed some life into the bond market rally. Regardless, we've got another leg lower down in bond yields on a 10-year. We're down 4 or 5 basis points. Looking at this economic data in response to it, down about 6 on a 2-year, back down to 4.25. And off the back of that move in the bond market, equities also just inflecting a little bit higher off session lows. We were down by close to 1% on the S&P earlier in the session. We're now down by just 0.5 on the S&P, and the euro session highs just about back through 104 on euro dollar.
It really highlights just how incredibly sensitive this market is going to be to data points next year, considering the fact that this is a Fed that is agile, that we're looking at this and maybe saying, okay, it's coming down. We might be able to potentially get it. Let's redo everything. No, but it raises this question of how volatile some of these points could be, given how uncertain the economic time is, particularly for economists.
Let's head out to one of those economists. Kathy Boszczanczyk of Nationwide joins us now. Kathy, welcome to the program. Let's look at the totality of the economic data so far. Put it all together: retail sales, S&P Global PMI, jobless claims, the data we just got. What's the picture look like from your vantage point?
Good morning, John. Happy to be with you. Well, the economy is strong. I mean, we're ending the year with growth somewhere, close to 3% annualized for GDP. And that momentum a large part of that will continue into the new year. And we just went through the income and consumer spending numbers. They're solid. They show that consumers have the wherewithal to spend because they're getting the income to support the spending. And that, at the end of the day, that's really what will drive consumer spending the most. Now, the wealth effect on top of that also turbocharges things. 20% plus gains in the equity market the last 2 years that and home prices being up over 50% since the pandemic, that also turbocharges things. Now, on the inflation front, really, these are very good readings. And I think somewhat surprising, as you mentioned, coming on the heels of what people thought was maybe a less dovish Fed reaction function, right, on Wednesday. But up a tenth. These are great numbers and better than some feared. So, what does the Fed do with all of this? I still think they pause early next year, but I think they're underlying, there's disinflationary forces here. What we don't know is what happens on the policy front.
Kathy, I'd love your thoughts on an issue that Lita has raised a few times since Chairman Powell spoke on Wednesday, and you can see it playing out in the market right now. There's some nervousness in equities and amongst investors that maybe the Fed's easing bias is being disrupted by the incoming inflation data. And you can see just a little bit of relief on the margin off the back of these numbers this morning, seeing equities start to bounce, bonds rally just a little bit more. What's your view on that? How disruptive has the Fed's easing bias been over the past few months?
Well, they still have an easing bias. Chair Powell made that very clear in the press conference. And you see that, they're still penciling in some rate cuts next year. It's just that it was 2, not 3 or 4. So the easing bias is still there. The question, to me, is does inflation get in the way of that easing bias? Does it get them to be more cautious? I do think the bar for easing has been raised. So they still have the easing bias, but that bar has been raised. And because we have uncertainty of what's going to happen, particularly on the tariff front and immigration, does that filter through to significantly higher inflation? Does the Fed look through that? These are one-off price increases or something more worrisome. That's where there's, I think, right now, this uncertainty.
Kathy, I remember when we used to care for a minute, this was actually one of the main indicators that Fed Chair Jay Powell himself was looking at, and that is inflation expectations. The University of Michigan 5 to 10-year inflation expectations that I'll be breaking down at 10 a.m. I will not be breaking them down at 10 a.m. Michael McKee will be breaking them down, but I do wonder if that's going to become really important now. This idea that if there is an entrenchment of inflation expectations among consumers, that will change the outlook for the Fed in a material way.
Oh, yeah, they're always important. I would say, even more so than the market expectations. Consumer expectations, really important, and those long-term, as you said, 5 to 10 year. As long as they're relatively anchored, the Fed, has comfort. What they don't want to see is, sharp increase in those 5 to 10 year. But the 1 year expectation, that could be moved around by food, energy, slightly higher prices temporarily. But if the long term stay anchored, that gives them comfort.
How much within the data that we've already seen are we seeing a stabilizing in terms of personal expenditures? We also got personal income and spending, and you were talking about how that continues to be robust. Personal incomes have been rising on a real basis. At the same time, we hear from retailers a lot of spotty types of performance, maybe cautious consumers. Have you noticed any trend? Are we inflecting back upward, or have we really declined in terms of the dynamism of the U.S. spender?
Certainly the consumers are price conscious, and certainly if you break it down among the income quintile, as you move down, middle income, lower income households, very price conscious. I think upper income households, as I mentioned before, if you're an asset holder and your wage gains are more than keeping pace with inflation, you're feeling pretty flush right now in your spending, and you're traveling and you're dining out. So that's really propelling things here. We're coming off remarkable 3 years, really, of strong consumer spending that's propelled the economy. Now, that said, I do think we moderate a bit. It is really tough to continue to see this type of strong growth well above underlying potential at a time. And I think here's the key. The labor market is still solid and strong. It's churning out jobs and income, but it's pretty concentrated. If you look at the cyclical sectors of the labor market, they're not generating any net new job growth. And I think that's what you hear from Chairman Powell and others, that cyclically, they are a little bit concerned we could get a slowdown, and they just don't want it to be too much.
Kathy, that's an important perspective. And we appreciate your time and your contributions this year. Thank you. Enjoy the holidays. Kathy Bosch-Jankit there of Nationwide. That last point is really important. The cyclical areas of the labour market, we've seen quite limited growth there. Housing, autos has been a bit of a struggle as well. And you just wonder if the Federal Reserve is going to keep on working off the aggregate, the headline number, which is what they're charged in doing. So you're going to see GDP that's robust, unemployment around 4%. Then that bifurcation we've seen in that economy, that disparity between the haves and the have-nots, it's going to become greater and greater in the year to come.
Which raises this question, which is the worse evil? The idea of hiking rates or keeping rates high to torpedo the economy and cause that unemployment rate to rise. Is that worse? Or is inflation that also is most punitive for those people on the lower end of the income sphere who might be more susceptible? It is sort of choosing between the two evils.
Mike, you're getting a second look at these numbers. What jumps out to you?
A couple of interesting things. One is that personal income rose significantly, both in October and November. October revised up to a 7/10 gain, 3/10 in personal income overall for the month of November, but wages and salaries were up 6/10, the most in at least 6 to 8 months here. So Americans taking home more money. It was the people who get dividends and stock payments, interest payments, who didn't quite get as much this time. Savings rate goes down to 4.4% from 4.5%. So we're still seeing people putting money away, and that's not going away. That helps a lot overall. So at this point, this looks like a pretty good number. And of course, the PCE inflation index, very low, 0.128. So it really does show progress in what the Fed is looking for in its main number.
Pushes bond yields down a bit more as well. Off the back of this data, we're down 5 basis points on 10s, 451. On 2s, down 5 or 6 to 426. Subhadra Jaffer of SocGen with us around the table. Subhadra, good morning.
Good morning.
I think before the Federal Reserve, you had 2s going down to something like 350 at the front end of the curve. Has that changed since you heard from Chairman Powell?
350 for the end of next year. So we don't really, I mean, we are anticipating more cuts next year. Our economists really haven't changed their call for the Fed because we just don't have much by way of new information. Yes, the Fed, the committee itself recalibrated to just 2 cuts for next year. But the way the economy has been going, you should see a moderation in growth. You should see a moderation in employment. You should see a moderation in inflation. And under the circumstances, the Fed might be able to deliver 4 cuts. But as a rate strategist, my bias is that they deliver less cuts. So the market is very, very efficiently priced in for a very benign policy path. But if they do deliver 4 cuts and aligned with our economists' call, then the 2-year could end the year next year around 3.5%.
Interesting. We've had a robust debate around this table over the last few days about what was behind and what underpinned those changes to the forecast of the Federal Reserve, the data or Trump. We're teasing out some of that information from officials on the FOMC. Mary Daly, the San Francisco Fed president, told us about an hour ago that for her it was the data. But for others, it was clear that it was also about the policies.
Yes.
What is it for you? What are you basing your calls on?
So I think it's going to be a bit of both, and I think it's going to be a constant recalibration process as we get new information hitting the tapes. And there's going to be a lot of that 3 a.m. tweets that we have to respond to next year, so we're all getting ready for that. It's going to be quite difficult depending on how the tariffs are rolled out. I mean, last go around, tariffs were over a 2-year period, and on sometimes on very specific products. This time, it could be much more of a sweeping tariff regime. So we're going to have to recalibrate as the data comes in. I mean, the Fed, I think, as we heard from Chair Powell, some of the Fed members are already incorporating some of the changes that could come down the pike, and others are not. And that's exactly what you're seeing among street economists.
What's your reaction function to the tweets?
It's funny because I'm now mentally preparing myself to wake up in the morning to stuff that I was not prepared for and then having to react very quickly. And our counterparts in Asia especially are looking forward to it because they can react to the volatility as it's happening because they're awake at 3 a.m. New York time to respond to the incoming news. So it's going to be interesting. It's just a paradigm shift to where we were between 2016 and 2020.
So things are going to get pretty noisy, right? I mean, it's sort of a question of, do you get more tactical or long-term, and how much is this increasingly a tactical market because of how obscured what's going on underneath actually is?
Yeah, no, it's going to be a very tactical market. We're going to have to constantly recalibrate. Just look at the last 2 days. We've gone back and forth on whether there's going to be government shutdown or not, based on information from either the Trump aides or from Trump. So you're going to need to see that it's going to be a lot of back and forth like that for the next 2 years, and then perhaps even next 4 years.
The things really are obvious. If you just take the example of this morning, we've all woken up to this post from the president-elect on Truth Social suggesting that if the Europeans don't close the trade deficit and buy more LNG, there'll be tariffs. I don't think it's clear what happens with that at all. The Europeans have already come out ahead of time and said we want to buy that LNG. I think Holly Crooks said a little bit earlier, referencing one of our colleagues, that they're pushing on an open door. At the moment. They want that to happen.
Of course.
There's an outstanding question whether that's enough to close the trade deficit, and whether if they don't, whether you actually get those tariffs. So I don't think anything's clear before you even begin to assess how inflationary or not those tariffs would actually be. There is nothing cut and dry about 25 and beyond.
Especially given the fact that even the reaction in markets, the reaction in the economy will look different, given that we're coming from a very different starting point. And I think about right now, you're talking about a government shutdown, and we did get a tweet from Donald Trump saying that let's shut it down now before I get into office, because then that's on his head, not my head. And I'm just wondering, what's the response to that in the fixed income market?
So I think that you're right in pointing out that the starting point is very, very different. And I'm really concerned about that from the inflation perspective, because between 2016 and 2020, inflation was not a concern. I mean, we had like maybe a 2-year decade period when, core CPI, core PCE never really exceeded that 2 to 2.5% level. Now our starting point is a lot higher. You're looking at core PCE around 2.8%. The economy is extraordinarily vulnerable to inflationary shocks on the services side. So I think that is really the game changer this time around, is that if you do see tweets and the market reacts and thinks that it's going to be inflationary, then you're going to see the volatility in inflation expectations. So the break-even market is not really priced for that. So I'm expecting a lot more volatility in inflation break-evens next year, because of the fact that we're in a very different inflation regime this time around as opposed to back in the Trump 1.0 timeframe.
Subhadra, it's good to see you. It's great to catch up. Appreciate your time. Thank you. Subhadra Japa there of SocGen. Your equity market recovers just a touch. We're down by 0.5% on a 3-day slide. Lisa, very close to making that day 4.
Yeah, a real question here about whether this is just sort of end-of-year rebalancing, or whether this is a structural shift, with the shift from recalibration to a new phase from the Fed, and potentially a real example of the volatility in Washington, D.C.
That new phase is we haven't got a clue.
That's correct.
Into New Year.
That's right. That's
the new phase.
It's agility.
Still trying to brand it, but ultimately that's the essence.
That's your branding?
That's the essence of it. That's not my branding. I'm just saying that's the essence of it. You can come up with a better name.
Okay.
Got 2 weeks. I'll see you in the new year. Okay. All right, let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Staying on Washington, media reports suggesting the House is working on another plan to avoid a government shutdown. Fox News reporting members will meet at 10 a.m. on a temporary fix, while NBC News is reporting Speaker Mike Johnson expects votes later today. President-elect Donald Trump also taking to Truth Social, saying, quote, if there is going to be a shutdown, let it begin now. Government funding is set to expire tonight at midnight. Meanwhile, the FAA has banned drone flights over several parts of New Jersey as sightings of mysterious aircraft continue. The agency has temporarily published 22 flight restrictions over critical infrastructure in the state, which it says was at the request of federal security partners. The announcement comes just a day after the FAA warned people that pointing lasers at aircraft is illegal, after seeing a dramatic increase this month in pilots reporting those types of incidents. And the Philadelphia City Council voted to approve the construction of a new downtown arena for the 76ers. The $1.3 billion plan had met fierce local opposition from residents, claiming the arena would devastate small business and landmarks in the city's Chinatown. Mayor Sherelle Parker has maintained the project will create thousands of jobs and help revitalize the area. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. You've got a name, have you? What have you got?
Choose Your Own Adventure.
Choose Your Own Adventure.
Yeah.
Okay.
Did you ever read those books? if you think that they should do this, turn to page 69.
All right, Sabantra's nodding along.
Yeah, you know exactly. You agree.
Exactly.
Yeah, okay.
I think that's exactly what it is.
There you go. Sabantra, thank you for everything this year as well. Thank you. Happy holidays. Appreciate it. Next on the program, we'll set you up for the week ahead. You are watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
The opening about 39 minutes away. Equities attempting to recover on a three-day slide and trying to avoid making it day 4. Equities on the S&P 500 negative by 0.6%, down on the Nasdaq by 0.9, and off on the Russell by 0.7. With your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. A humbling moment for Novo Nordisk. One of the new experimental weight loss drugs simply hasn't hit the benchmark. It's a new weight loss drug. It's called CagriSema. Now, CagriSema, basically, the promise was you'd lose 25% of your overall weight over 68 weeks. That comes in at 22.7. That is a disappointment to the extent of $120 billion of a wipeout, 30% of value. So that is a humbling moment. We've come off those lows. It's all about defending your market share against Eli Lilly. Of course, their bid this morning off the freight unit. BI have run the numbers. They reckon it's worth about $30 billion. It'll happen probably in the next 18 months. It allows them to focus on the core business, which I can tell you is the canary in the coal mine of delivery, because here in the United States of America, demand for the express business is light, especially in the United States of America. Nike, low double-digit growth. The ghost of John Donahoe lies over this particular stock, Jonathan. Elliott Hill came out of retirement, This was his moment to tank everything, all the stock he didn't want, and draw a clear blue line between him and his predecessor. Bloomberg opinions say he missed that moment, he missed that opportunity. They're guiding low double-digit growth. This was your moment to say, now, that's your stock, that's your inventory, that's your problem. I've got a plan. It's a global plan. I'm going to re-premiumize Nike. Jonathan, happy holidays.
Thank you. Happy holidays to you too, sir. Appreciate it. As we count you down to the holidays and the opening bell, your trading diary through the weekend and into next week looks like this. At 10 o'clock Eastern Time, UMich sentiment, 12 a.m., the deadline to avoid a government shutdown. Monday, consumer confidence. Tuesday, durable goods. Wednesday, U.S. markets are closed for Christmas Day. Congress, of course, racing to prevent a government shutdown as we go into the weekend. Anne-Marie is joining us now from Washington, D.C. AMH, what is the latest? How close are we to a government shutdown?
Well, there's still so many questions swirling around Capitol Hill and whether or not we are going to be shutting down. You wake up this morning and you thought potentially that was what I was looking at, 12:01, there was going to be a government shutdown. And then we have House Speaker Mike Johnson coming into the Capitol saying, we've got a plan and expect votes this morning. The issue is there's no bill that's been filed yet. So what exactly would he be bringing to the floor? Do we just not see it yet? Or potentially is he going to try the bill that failed yesterday, maybe if he was able to get those 38 Republicans that voted against it to say yes. Lots of questions, not a lot of answers right now, and time is of the essence. We could be headed for a shutdown just before the holidays.
Anne-Marie, why not just pass something, push the can down the road like they always are going to anyway, and let us all go on vacation without the worries of extra delays because TSA workers won't be getting paid?
Well, the thing is, they might end up coming to that. It might just end up being, as Doug Redeker put it to me, the cleanest of cleanest CRs, literally just kick the can down the road. The problem is, President-elect Trump injected himself into this problem, which also says to me, did Speaker Johnson have his buy-in for the bill that he originally wanted to put on the floor, that he negotiated with Democrats? Because it doesn't seem like President-elect Trump wanted that. It seems like President-elect Trump wants to clear the decks before next year. He doesn't want to deal with any of this, including the debt limit, which will become an issue starting in January. And his inauguration is January 20th. So it doesn't seem like they got the buy-in from President Trump, and that's causing a lot of problems right now for the speaker.
We've got to clear the decks right now. Anne-Marie, I know you're taking over next week, and you're not going into the holidays, but for Lisa and me, we are. AMH, thank you for everything this year. Happy holidays to you. We'll talk on the phone later. Thank you. Thank you very much. Bramo, that does it for us.
Yeah,
going into year end.
All I can say, you're just rubbing it in. You'll be here.
No,
have a great time. We're gone.
AMH would have pointed that out for me.
Exactly. Well, the truth is, have a wonderful, wonderful holiday. I will say this has been quite the year.
Hasn't it just?
I mean, it feels like about 10 years, and probably, let's hope for a calmer year next year.
I know I've said this already this year, but thank you to you at home. I think we all consider you, what I say all the time, to be the most intelligent audience anywhere on the planet. And thank you to everyone in this building for making this program happen. There's a lot of work that goes on in the kitchen. We just get the honor of serving the food. Thank you. Have a very happy holiday at home with the family. And I look forward to seeing you all in the new year. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Fed's latest announcement, and we're going to dive deep into why.
Okay.
We've got a fresh analysis from Pound Sterling Live, aptly titled,
Right.
Pound to dollar rate swoons after Fed dials back rate cut ambitions.
Mm-hmm.
So what's the connection between the Fed and the pound's sudden dip? And more importantly, what does it mean for you?
Yeah, it's a fascinating example of how interconnected the global financial system really is.
You're right.
What seems like a purely American monetary policy decision can ripple out and impact currencies across the globe.
Okay, so let's start with what the Fed actually did.
Right.
They cut interest rates by 25 basis points. But here's the catch.
Okay.
The markets were expecting a more aggressive move.
Right, and that's why this seemingly small cut sent such a shockwave. Remember back in September when the Fed projected 4 rate cuts for 2025?
Yeah.
Well, now they're only anticipating 2, totaling a 50 basis point reduction.
Oh, wow.
This less accommodative stance, combined with only 1 dissenting vote to keep rates unchanged, really threw people off.
So it's not just the rate cut itself, but the signal it sends about the Fed's thinking, right?
Exactly. The markets are reading this as a sign that the Fed is more concerned about inflation than previously thought.
Okay.
They're essentially saying, we're going to tap the brakes on these rate cuts because we think the economy is strong enough to handle it.
And this tapping the brakes is what economists call a hawkish stance.
Right.
But the interesting thing is the Fed also raised its GDP growth forecasts for 2024 and 2025.
Okay.
They're now projecting 2.1% growth in 2025, up from their previous projection of 2%.
Yeah, it does seem counterintuitive at first glance.
Yeah.
You'd think higher growth projections would make them more inclined to cut rates to keep the momentum going.
Right, especially since they've also revised their inflation expectations upward for 2025 and 2026.
That's the real head scratcher.
Yeah.
They're acknowledging that inflation might stick around above their 2% target for longer.
Right.
Yet they're still pulling back on rate cuts.
So what's the logic here? Are they just overly optimistic about their ability to control inflation?
It's a calculated gamble, for sure.
Yep.
They seem to believe that the economy is robust enough to withstand slightly higher inflation without derailing growth. They're betting that they can thread the needle between supporting economic expansion and keeping inflation in check.
But couldn't this backfire? What if inflation proves stickier than they anticipate?
It's definitely a risk,
Yeah,
and one that's making some economists nervous.
right.
They argue that the Fed might be underestimating the persistence of inflation, and that this less accommodative stance could ultimately stifle growth.
So the jury's still out on whether this was the right move.
Exactly. Only time will tell how this plays out.
Yeah.
But one thing is certain.
Yeah.
The markets are taking notice.
Okay.
The dollar is surging as investors flock to U.S. assets attracted by the prospect of higher returns.
Which brings us back to our friend the pound, who's feeling a bit bruised after this whole ordeal.
Yes. The pound-to-dollar exchange rate took a significant hit, dropping to 1.26012 after the Fed's announcement.
Okay.
That's a 0.65% decrease, which might not sound like much.
But it can make a real difference, especially if you're planning a trip across the pond.
Absolutely. A weaker pound means you'll get fewer dollars for your money, making everything from hotels to souvenirs more expensive.
Ouch. Not ideal for those dreaming of a London getaway. But even if you're not jet setting anytime soon, this exchange rate shift can still impact you.
Think about anyone sending money overseas or businesses importing goods from the U.S.
Right.
This fluctuation can affect their bottom line.
So it's a reminder that even seemingly distant financial decisions can have a tangible impact on our lives.
Precisely. And this is just the tip of the iceberg. We haven't even touched on the potential global ripple effects of this Fed decision.
Right, because we're not just talking about the dollar and the pound here.
Right.
This has the potential to trigger a chain reaction across the entire global financial system.
And that's where things get really interesting. The U.S. economy is like a giant ship in the global financial sea. When it changes course, other ships have to adjust their sails.
And right now, it feels like the Fed is steering towards less choppy waters, leaving other central banks to navigate their own rough seas.
Right.
So how are they likely to react to this shift?
It puts them in a bit of a bind, really. They have to balance their own domestic economic conditions with the pressures of a strengthening dollar. If they don't follow the Fed's lead and raise their own rates, they risk their currencies weakening,
Right.
leading to inflation as imports become more expensive.
So it's a delicate balancing act.
Yeah.
They don't want to import inflation, but they also don't want to stifle their own growth by raising rates prematurely.
Exactly. It's a game of strategy, watching what the Fed does, assessing their own economies, and trying to anticipate the ripple effects of their decisions.
And with the global economy already facing headwinds like slowing growth in some major economies, this adds another layer of uncertainty.
It certainly doesn't make things easier. The Fed's less accommodative stance could lead to tighter financial conditions globally,
Right.
potentially exacerbating those slowdown concerns.
I'm starting to get a sense of why the pound swooned. It's not just about the direct impact of the dollar strengthening. It's about this broader anxiety rippling through the market.
Precisely. It's a collective holding of breath, waiting to see how this plays out.
Yeah.
But amidst all this uncertainty, it's important to remember that economics isn't a crystal ball.
Right.
We can analyze data, consider different perspectives, and make informed decisions, but we can't predict the future with certainty.
So no guarantees, but we can stay informed and try to anticipate the most likely scenarios.
Right.
And speaking of scenarios, what are some of the factors that could really throw a wrench in the works, even if the Fed's gamble on the U.S. economy pays off?
Well, you always have to factor in geopolitical events.
Right.
Trade tensions, political instability.
Yeah.
Those things can have a massive impact on the global economy, regardless of what central banks are doing.
Right. A sudden conflict or a major policy shift could easily derail those optimistic growth projections the Fed is banking on.
Absolutely. And then there are the unpredictable events like natural disasters.
Oh, right.
You can't model for a volcanic eruption disrupting supply chains or a pandemic sweeping the globe.
It's a humbling reminder that even with all our economic models and data analysis, there are forces beyond our control that can completely reshape the landscape.
And that's why staying informed and adaptable is so crucial.
Yeah.
It's not just about understanding interest rates and exchange rates.
Right.
It's about grasping the complexity of the interconnected global system and being prepared for the unexpected.
Okay, so we've got the Fed's surprise move, the dollar surge, and the potential for global ripple effects.
All right.
It's a lot to process, but let's bring it back down to earth for a moment.
Okay.
What does all this mean for our listeners, the everyday folks trying to make sense of their finances?
That's the key question, isn't it? How do we translate these global economic shifts into personal financial decisions?
Exactly. Because at the end of the day, it's about how this impacts our wallets, our investments, our ability to plan for the future. So we've got this swirling storm of global finance. The Fed's doing its thing, the dollar's flexing, and the rest of the world is trying to keep up. But what does it all mean for us here on the ground?
Well, think of it this way. The Fed's less dovish stance, it's like a signal flare going up. It's telling us that they're more confident in the U.S. economy's ability to handle a little rough weather, even if that means higher interest rates and a stronger dollar.
So for someone listening who's thinking about buying a house or taking out a loan, this might not be the best news.
It's something to be mindful of, certainly.
Yeah.
If the Fed continues on this path, we could see those borrowing costs creep up.
Right.
It might be worth exploring locking in those low rates sooner rather than later, depending on your individual circumstances.
But it's not all doom and gloom. A stronger dollar could also mean some benefits for consumers, right? Like cheaper imported goods, maybe?
That's one potential upside. If you're buying products made overseas, you might see some price breaks.
Okay.
And if you're planning a trip abroad, your dollar will stretch further.
Okay, so it's a mixed bag, benefits for travelers and import shoppers, but potential headaches for borrowers.
Yeah.
What about investors? How should they be thinking about this?
This is where it gets really interesting. A hawkish Fed can create opportunities in certain sectors.
Okay.
For example, financials tend to perform well in a rising interest rate environment.
Right.
But on the flip side, growth stocks might take a hit as investors shift towards more value-oriented investments.
So diversification is key, as always. Don't put all your eggs in one basket, and make sure your portfolio is aligned with your risk tolerance and long-term goals.
Exactly, and don't be afraid to seek guidance from a financial advisor if you need help navigating these shifting tides.
Great point. It's easy to get caught up in the headlines and make impulsive decisions.
Yeah.
But having a solid financial plan and seeking expert advice can make all the difference.
Absolutely.
Yeah.
At the end of the day, knowledge is your most powerful asset. The more you understand about how these global financial forces work, the better equipped you'll be to make informed decisions for yourself and your family.
Couldn't have said it better myself. It's been a wild ride unpacking this Fed decision and its ripple effects, but I think we've managed to shed some light on the complexities and what it all means for our listeners.
It's always fascinating to delve into these topics and see how seemingly abstract financial moves can have such tangible impacts on our everyday lives.
And that's what we're all about here on The Deep Dive, connecting the dots and making these complex issues accessible and relevant.
So to everyone listening, stay curious, keep learning, and don't be afraid to ask questions. The world of finance might seem intimidating, but with a little effort, anyone can grasp the basics and make smart choices.
Exactly. And remember, we're here to help you navigate those choppy waters. So until next time, happy investing, happy traveling, and may your financial journey be ever in your favor.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
See, the reason this is a bold call, Christina, is because a lot of people, notwithstanding today's data, are very worried about those inflationary pressures that could be brought on by potential policies by the president-elect. How concerned are you about those policies, and how would those change your view on that four-cut view?
Well, I'm absolutely concerned. I'm actually more concerned about mass deportation in terms of its impact on inflation than I am about tariffs. Tariffs can be threatened, they can be quickly removed. Deportation is a much more significant, more permanent kind of situation. And of course, where we know a lot of inflationary pressures come from is the labor market. So if we have a tight labor market, especially in certain industries, that tightens further, that can be very problematic. But I believed Chair Powell in his November press conference when he said that the Fed wasn't going to guess, speculate, or assume about Trump administration policies because they didn't know the timing and they didn't know the scope. That's still the case today. We don't know the timing, we don't know the scope. So it's, I think, important not to anticipate anything and to wait and see how this unfolds and how it shows up in the data. Because, for example, tariffs could be, in the short term, inflationary, but longer term could actually be deflationary in terms of really softening demand, especially if we see 60% tariffs.
Right.
So I just don't want to jump the gun on this. This, to me, is a situation where we want to be data dependent. What the data is showing us, including today's PCE, is that we are on course. We're moving, perhaps slowly, towards target. But we know that disinflation is an imperfect process.
Right.
And that we can sort of have progress in one quarter and then a lack of progress in another. Recall first quarter of 2024, the Fed was very disappointed in a lack of progress and then was very encouraged by progress in the second quarter.
So there's a lot to dig into there. I'm glad you brought up mass deportation because Matt Miller, who's somewhere in Spain right now, he's been talking about this a lot, the effect that, you know, if you deport out a large part of the labor market, that what does that mean for inflationary pressures? But it sounds like what you're saying, all of these what ifs, that you're not ready to invest around them just yet, a wait and see sort of approach.
Absolutely. From my perspective, what we're seeing is a pretty orderly environment where the Fed is reacting to the data. We're seeing disinflationary progress continue. We're on track to get closer to the target. And I think we'll actually see an economic reacceleration next year. Markets are likely to discount that in advance. And of course, we have to take a step back and not just look at the U.S. The broader environment is one in which monetary policy is easing. And it will continue to ease because it is restrictive at current levels.
I want to take a look now because you have the S&P 500 down more than 3% on the week already, and you have futures down even more today. That is the worst week you're seeing since early September. If we look at the babies thrown out with the bathwater here, we're looking at sectors that were really sold off, and you have everything from real estate to energy materials. Almost every major group has sold off over the last 5 days. Christina, do you see buying opportunities in that bunch?
Oh, absolutely. First of all, I should take a step back and say this is not surprising when we go back to 2016, right? We saw a strong rally coming out of the election. We saw very significant gains up until the peak on December 13th. And then we saw give back for the last few weeks in December of 2016. So I kind of anticipated that we'd probably see a pullback. Of course, it was incredibly exacerbated by that surprise dot plot. So where we find ourselves today is with certainly more bargains than we saw a few weeks ago. But I will say that if we look broadly, not only there are opportunities in the U.S. where valuations are bit better. But if we were to look in small and mid caps, valuations are more attractive there. Cyclicals haven't really participated in a lot of the multi-year rally we've seen. And of course, if we go internationally, that's where we can really get some bargains.
All right, well, that is a 2025 conversation because we have to leave it there. Christina, it's great to see you. Happy holidays. That is Christina Hooper of Invesco. Let's go check on these futures because it is not too pretty right now. The S&P 500 down about 0.6%. The NASDAQ 100 down about 0.8%. Both of those indexes off by 3% for the week. The Russell 2000, your small caps really in the hurt locker, of course. A lot of question marks over whether and by how much the Fed is going to bring rates down. That is a lot of cross currents for those small caps. The Russell 2000 down about 0.4%.
We'll see what the next week brings. It was supposed to be the last day that mattered, then the days after still mattered. Stick with us, because coming up next, we're going to talk about a stock that matters today. That's FedEx confirming a spinoff, why the company is separating its freight division within the next 18 months, and why investors like it oh so much. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
High interest, a look at what's making headlines around the world. iPhone maker Foxconn is putting its interest in Nissan on hold while the Japanese automaker continues merger talks with Honda. Former Nissan chairman Carlos Ghosn tells Bloomberg what Nissan's potential merger with Honda means for the struggling automaker.
They have cash problem, they have investment problems, they're being really hammered in the United States. They got practically out of Europe. They're being challenged in China, and there is no plan in front of it. So I can tell you that there is panic mode inside Nissan.
And over in the U.S., The U.S. has filed a murder charge against Luigi Mangione that could bring him the death penalty if he's found guilty. The federal criminal complaint against the suspect in the United Healthcare CEO killing includes 1 count of using a firearm to commit murder, along with 2 stalking counts and a firearms offense. And tensions are building between Amazon and the Teamsters Union. The union called on thousands of Amazon workers to walk off the job yesterday and is threatening more action just ahead of the holiday rush. In response, Amazon says it's filed unfair labor practice charges against the union, Katie, and I know we're going to stick on just this type of story.
Exactly. Staying on parcels here, we're taking a look at shares of FedEx soaring pre-market. That's after it said last night that it plans to spin off its freight division into a separate publicly traded company within the next 18 months. Joining us now for more is Lee Klasko of Bloomberg Intelligence. And Lee, this was expected to some extent. We know that FedEx in June said that it was reviewing specifically the freight business, but clearly investors happy about this actual announcement now that we have it. Why does it make sense to separate here?
Yeah, so I think there was a lot of expectations that during this quarter they were going to announce whether they're going to spin or not spin. I think, why it makes the most sense is that they're really able to unlock a significant amount of value, less than truckload carriers, which FedEx Freight is, and it's also the largest one in North America. It tends to trade at a higher multiple than the parcel industry. It tends to be higher margin business. And it has a lot going for it over the long term. It's a market, like I mentioned, it's pretty consolidated. It's continuing to consolidate, and they have significant, or maybe not significant, but very good pricing power, which tends to be, a really good long-term story for these LTL carriers. Kind of nearer term, they are facing some demand headwinds, which we saw in the quarter. Demand was slightly below expectations. And that's really driven by the industrial economy. The LTL business is really more geared or leveraged towards the industrial economy, to roughly 75% industrial manufacturing and 25% retail. That retail and consumer part is growing, but that is what's really been driving it. And IP, industrial production, is expected to accelerate next year, but again, near term, the headwinds as related to ISM, because ISM is a pretty good indicator for LTL demand. It's been a contraction territory for 24 of the last 25 months.
It's interesting because the enterprise value that you see from this business to be spun off could be as much as $33 billion, according to your analysis. I don't know that a lot of investors realize just how big this business was. For new investors who might want to buy into that business, what's the growth rate? Because is there a rationale to buy it in an IPO or to have even a financial strategic buyer come into this?
Right. We don't do buy, hold, sell recommendations at BI, but we don't think a strategic buyer is going to be coming in. Because you're not going to have one of its peers buy it, because it is, like I mentioned earlier, the largest LTL carrier in North America. There could be, some issues with 2 of those large players merging. We thought that if anyone would come in, it could be like a Maersk that is looking to maybe further diversify their business, because they want to always get deeper into supply chains. And the North America market is a very attractive market as it relates to the trucking industry. So, in our view, we thought the most likely outcome was going to be a spin. Secondarily, maybe a large player, like I mentioned earlier, like a Maersk or a DSV in Europe, could be interested. But we didn't think a financial player would come in because, FedEx has pretty good margins. They're not industry leading. That's Old Dominion. There's roughly around 800 basis points of delta between their margins or operating margins. But Old Dominion network is a little unique. But FedEx does have the opportunity to close that gap. Maybe not get it as low, but they definitely could close the gap. But that might not be too compelling for a financial buyer.
All right, Lee, keep in touch, of course. A fascinating story here. That is Lee Klasko of Bloomberg Intelligence talking about the FedEx spin-off news. FedEx shares of about 8.5% pre-market as we look ahead to a new era for FedEx. But we do want to bring you some breaking news now, and that is on Carnival reporting earnings. Fourth quarter adjusted EPS beating estimates, more than double, or rather double expectations, 14 cents versus a loss per share of 7 cents. So interesting there. You can see that shares up about 3.7% pre-market. You also had revenue come in at $4.94 billion. That was also ahead of estimates. Good news for a stock that's already flying year to date, up about 36% on a total return basis. And we'll be speaking with Carnival CEO Josh Weinstein coming up at 2 p.m. New York time later today. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, welcome back to Bloomberg Open Interest. We're minutes away from what looks to be a pretty hairy opening when you take a look at the major indexes right now. The S&P 500 down about 0.5% pre-market. We saw a little bit of a bid at some point yesterday. That obviously faded. So we're looking at another down day. We're down 3% this week, one of the worst weeks of the year. Then you take a look at big tech, and it's not too much better. The NASDAQ 100 actually down about 0.7% right now. The small caps also struggling. The Russell 2000 off by about 0.4%. Stick with us through the open. A lot of single stock moves to sort through. We'll bring it to you all live. This is Bloomberg. Oh, just kidding. We have a minute. What is this?
I know, a minute to the opening bell. But a lot is moving before the market. I mean, the one thing I was looking at in addition to the market moving, Katie, was the market pricing. Because fascinating, the bond market really was the tail wagging the dog this time around, wasn't it?
Absolutely. It's interesting, though, to see the bond market actually get a little bit of relief today. Yields are actually lower, but these high levels that we're at, that danger zone that we've been talking about at about 4.5%, it doesn't seem to be providing any relief to the stock market right
I wonder if you need a new danger zone, because you have Torsten Slok this week coming out saying there's a 40% chance that the Fed hikes next year, not cuts. You have the market pressing in less than 2 cuts into the end of next year, and the moods are changing quickly, Katie.
Okay, now I promise we're going to break. The opening bell is up next. Don't go anywhere. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
All right, we are moments away from the start of trading on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld, and it looks like the final trading week of 2024, the final full trading week, is going to be an ugly one. You take a look at where futures are right now, seconds before the bell. It's red across the board, of course. That traces back to Wednesday when we finally heard from Jerome Powell in his final meeting. Now you have the bulls in this market seeing dots. And it'll be interesting to see how that trade develops in 2025. But at least in the final days of 2024, sentiment has absolutely collapsed. But in any case, you do see the bells, and you hear the bells ringing right now over at the New York Stock Exchange and at the NASDAQ right now. Just about 18 seconds into the trade, let's take a look at where we opened up right now. The S&P 500 down about 0.5%. That brings us to about 3.5% lower on the week. One of the worst weeks of the year, and I can say the same for the NASDAQ 100, currently off by about 0.8% at this moment. The small caps, this has been where a lot of the pain has been felt most directly. The Russell 2000 down about 1% right now. Of course, this is your loss leader on the week as those small companies grapple under the potential of higher for longer. Meanwhile, let's take a look under the hood, though, because we do have some good news, and that is Eli Lilly. It's jumping, but that's after its competitor Novo Nordisk delivered results from its latest weight loss study that fell short of expectations. You have Novo dropping by the most on record, with investors betting that Eli Lilly catching up to the first mover in the weight loss drug market. Shanali.
I'm keeping an eye here on another mover. On the upside, we're looking at FedEx here. It's looking at a gain of more than 5% right now as the market opens. It said that it's spinning off its freight division into a separate publicly traded company, one that Bloomberg Intelligence believes could be with an enterprise value of as much as $33 billion. Nothing to cry home about. Let's flip up the board, look at Nike, because that is lower. The new CEO, Elliott Hill, made a big earnings debut, but he said his turnaround efforts may hurt earnings in the short term, and you have Nike down just about 1.5%. We're going to take a closer look at Nike with Poonam Goyal of Bloomberg Intelligence, and I think back to our conversation yesterday. And what we were grappling with was the recognition that you had made that we were not going to get a full plan. Stock is down, not by all that much, all things considered, but how high is the bar now for him to move faster to get that turnaround story on the table?
I think the turnaround story will still take time. As he alluded on the call, the back half of Nike's fiscal year will be challenging, with the fourth fiscal quarter even more challenging than the third, where they see a low double-digit sales decline. So I think we're looking at fiscal 2026 at best to see signs of better sales and momentum actually picking up, which means the back half of next year is probably the earliest when we'll start to see some positive news from Nike.
And Hill did address that on the call. You think about, what's on his to-do list right now, and he said, quote, "I recognize that some of these actions will have a negative impact on our near-term results, but we're taking the long-term view here." You're not seeing that long-term view being expressed in the stock right now, Poonam, but it sounds like you do have confidence in the long-term vision.
Absolutely. I think he's doing the right stuff. I mean, in order to get any company back to where it was, you need to clean house. And that is what they're doing right now. They're getting rid of aged inventory, which is going to cause margins to drop and sales to drop as price drops. So that is much needed before they can actually move forward. It's the playbook of any turnaround story. You have to cut out the fat to actually get moving forward.
Well, it'll be fascinating to check in on Nike this time next year, because for this year, year-to-date, shares down 28%. Poonam Goyal, Bloomberg Intelligence. Have a great weekend. Let's broaden out this conversation now with Louis Navalier. He is Navalier Associates Chairman and Chief Investment Officer, joining us on set on this Friday morning. Great to see you.
It's great to be here.
Let's talk about the Fed, because you take a look at that dot plot that spooked everyone, that expectation that the Fed will only cut by twice 50 basis points in total next year, really sent ripple effects through every single market. Did it surprise you?
No, they can only see so far, but they'll probably cut rates 4 times next year because we expect interest rates to collapse in Europe. Bloomberg did a survey that said the rate should be 2% by June. Some economists have it at 1.75. So we got 4 to 5 more rate cuts from the ECB because Europe's in a horrific recession. They're also leaderless right now, at least France and Germany are. And so as those rates come down, it should drag our treasury yields lower. And of course, we have an incredibly strong dollar, and the treasuries are supported by all this international buying pressure. So I do expect 4 cuts next year.
Why do you believe that with inflation where it is right now? What do you tell people who are still concerned about it heading into the next year, and then maybe even more concerned about it when you think of some of the potential policies that you might see from the president-elect?
Okay, so we had a very good PCE this morning, okay, better than expected. And if you back out owner's equivalent rent, shelter costs, we're already at 2%, okay? So the Fed hit their mission, and the only problem is something about Manhattan real rents and rents in Baltimore. Everywhere else, prices are being cut. I mean, I flew up from Florida. Trust me, prices are soft there now. So, eventually owner's equivalent rent's going to come down, okay? And then we'll be just like Europe. I mean, they don't have rental inflation over there because they're losing households. And that's the one big thing people have to realize. The rest of the world is shrinking. China lost, 2.08 million people last year. Europe's shrinking. At least in America, we're growing. We have household formation, we assimilate our immigrants, and we're the economic engine of the world.
It's a good point, too, on PCE, of course. Not as hot as expected, and I wonder how different the conversation would be had we gotten that number 2 days before the Fed instead of 2 days after. But talk to us about how that translates through to the long end of the Treasury curve. You mentioned, rates coming down. Are you ready to add to long end duration here? Because that's broken a lot of hearts in 2024.
Well, I'm not the bond guy. I'm my own bond expert. But I will say this. I think the reason the yield curve was so inverted for so long is Janet Yellen could not manage the long end of the curve. A couple years ago, she had some disastrous Treasury auctions. The bid-to-cover ratio got out of control. And so she just kept selling more short and intermediate debt, which everybody was happy to take. Now, Scott, our new Treasury Secretary, is coming in, and that'll be his job to manage that.
It's interesting because we think about the run over to the S&P 500. Going into this morning, you had just mentioned that the S&P 500's reaction to the Fed release here was fairly choppy, but you look at the year, it's still a good year. You're looking at the S&P 500 still up more than 20%, but what strikes me is the divergence. You have stocks like Vistria up 252%, Nvidia up 160%. On the other hand, you have Intel and Walgreens each down more than 60%. If you had a market that was up more than 20% in a year as choppy as this one, how do you treat the laggards? Can they be forgiven at a time where so many tides
No, they can't. This is, other than financials, this is not a sector market. And, NVIDIA is my largest holding. And, AMD and Intel score very poorly on our system. They're Ds and Fs. We grade stocks A, B, C, D, F. Vistra's also one of our big winners. If there is a theme out there, we got to double the power grid. Now that Trump's coming in, they can do that with natural gas. And so that's going to be very exciting. And because, normal search is like 2% of our power grid, but AI search is at least 4%.
Right.
So as the AI gets faster and faster, we're just going to be using a lot more electricity. So that I have several companies that are building out the utility grid. And green energy works, but you have to have a transmission line called a DC grid, and they don't have the grids for that. So if we get serious about green energy, maybe we can put in some better grids. Maybe Musk will tell Trump to do that.
Perhaps a lot of big question marks heading into next year. But I actually want to talk a little bit more about that point you made that this isn't, aside from financials, a sector market. Can you expand a little bit more on that? We were having a conversation with Jean Bovin at the start of this week talking about how don't look at this as an asset class market. Look at this as a narrative and a story-driven market. And it sounds like you might be saying something similar.
Yeah, my whole thing is all my research is online free. I launched a book with Wiley in 2007 to launch our stock grader. We have an encore book coming out. But basically, we like to paint a picture of the market's very fickle, and we always test our models. And right now, they're decaying at a very orderly rate. I will add that the breadth and power got slightly better, but it's still, everybody wants the winner. I know everyone wants to talk about the Magnificent Seven. I like to talk about, NVIDIA and 499 other stocks. So, it's everybody just wants to latch on to the winner, and look at what happened to Musk recently, how his net worth went up,
That's true.
Louis, we have to leave it there. We wish we could have you for longer, but come back with us in 2025. We're going to want your top picks for the new year. That is Louis Navellier and Associates Chairman and Founder. Now, coming up, we're going to talk politics because Donald Trump's party had voted against them in this instance. The president-elect had his first big test of lawmaker loyalty. We're going to talk about the budget dispute. This is Bloomberg.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on stocks about 13 minutes into the session. Still down, but a little bit better than where we were at the open. The S&P 500 now off by about 0.2% right now. We had been looking at losses of 0.5%, so a little bit better. The NASDAQ 100 also clawing back here, still down about 0.5%. Then you take a look at the small caps. The Russell 2000 making a run for it, currently higher by about 0.1%. We'll see if that holds. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, BMO is downgrading drug makers today, including Merck, amid mounting skepticism across the pharma industry. The analyst says that Merck is no longer a buy and that shares could be stuck in limbo over the next year. Next up, Citi says that French fry maker Lamb Weston no longer a buy, downgrading the company to neutral. Remember, Lamb Weston reported a second quarter earnings miss, cut its guidance for next year, and announced that its CEO was leaving, so a real triple whammy there. And the analyst also says that the company's recovery will take longer than expected and be limited by price competition. And finally, we have Morgan Stanley upgrading the owner of Chili's, saying that it's no longer a sell. Brinker's international strong turnaround appears to have legs, according to the analyst, and recent data suggests that the company is performing well. Shares up about 1.3%. Meanwhile, let's turn to politics, because the Republican-led House voted down the plan backed by President-elect Donald Trump. The rejection sets the stage for a potential U.S. government shutdown, with funding set to lapse at midnight. Joining us now from Washington is Bloomberg's Mike Shepard to help make sense of it all. Tell us about the 38 Republican lawmakers who voted against this, Mike.
Well, this is a signal, Katie, that not everyone is going to fall into line automatically with Donald Trump on what he says on his legislative priorities. And these include the debt limit. He called for eliminating the debt limit as part of what he would see an acceptable version of this temporary spending bill. Now, the debt ceiling is seen by a number of conservative fiscal hawk Republicans in Congress as, let's say, a guardrail against excesses in spending by Congress, by the federal government, and they don't like seeing it raised, let alone eliminated without much thought. And so, therefore, we saw last night 38 Republicans join Democrats in opposing this bill, and with the margins in the House and also the Senate not favoring Republicans, this bill failed. And now they are scrambling. They are back to the drawing board. It's unclear even whether they have a Plan C. Plan B failed last night, and whether they'll have support for it in time to get a vote before midnight, which is when funding expires.
I do want to ask more about the vote itself, but when we think about the posturing between the House Republicans and the president-elect, I do feel compelled, Mike, to ask you about what this means for other large issues down the road, say nominations. Does it mean that there could set up for larger fights in Washington heading into next year after the inauguration?
That's a great question, Shonali. And actually, one of the reasons Donald Trump would like to see the debt ceiling handled now rather than during the coming year, he wants Congress to be able to focus on his policy priorities, and those include the border and tax cuts. And he wants those done as soon as possible, even within the first 100 days of his administration, which is a symbolic achievement, but it's also something that would gain momentum for his agenda. If Congress also has to deal with the debt limit, which snaps back into place, by the way, on January 1st, that would really slow things down. Let's turn the clock back. In June 2023, you and I both will remember just how messy that was and how it shook financial markets. We came within 3 days of a historic default the last time around, the last time Congress had to debate the debt limit. So basically, Trump is trying to clear the decks for his agenda, but it is not going to be as easy as he thinks, in part because the party margins in Congress are so narrow. He doesn't have nearly the mandate that he is trying to suggest or trying to project on social media and elsewhere, even before he takes office.
So a lot of big, impossible to answer, at least for right now, questions when it comes to next year. But let's talk about January 3rd, and let's talk about the speaker vote, because Mike Johnson, I would imagine he would like to keep his job. It feels like he only just took over, of course, October 2023. What does it look like for his political future?
This is a really tough question to answer, only because it is so fluid at the moment, and his caucus is not seeing a lot of reason for confidence in him. Just last week, he was at the Army-Navy game in the presidential box with President-elect Donald Trump, watching the game, signaling some sort of proximity to the president-elect and the incoming administration. And yet, just a matter of days later, Donald Trump, joined by one of his closest advisors, the world's richest man, Elon Musk, just barged into these budget negotiations that have taken weeks and disrupted and upended legislation that Johnson himself had led the negotiations on and really was steering toward a vote to avoid the kind of drama that we're in right now. So all of this does not bode well necessarily for Johnson. We heard Ralph Norman the other day on Bloomberg television telling us that, hey, this is not a great moment for Johnson, and this is something that is cause for concern among Republicans who would have to vote on whether he should return as Speaker starting next year in the next Congress.
Certainly, the GOP grappling with what it means to have more cooks in the kitchen. Bloomberg's Mike Shepard in D.C. We can't take our eyes off it. Thank you so very much for all of your reporting. Now, coming up, dissent at the Fed. More on why the Cleveland Fed president voted against the Fed's latest rate cut. That's next in our Wall Street Beat. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
My projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
That was San Francisco Fed President Mary Daly speaking earlier, and it's time now for the Wall Street Beat. Cleveland Fed President Beth Hammack writing about her dissent from the Fed's latest decision to cut rates, saying the following: a stall in inflation above 2% for too long would risk de-anchoring inflation expectations, making it harder to return inflation to our objective. Joining us now, Michael McKee, Bloomberg's chief economics and policy correspondent. When you think about what Beth Hammack is saying here, and first of all, her kind of dissent is adding a lot of excitement to the Fed in an already exciting year, isn't it? But how does it pair with what you're seeing in other data about where inflation expectations are heading?
Well, it's kind of ironic because she pointed out today that we'd seen inflation stall, and she does not want to see to be cutting rates until she sees progress on inflation going back down again, which a half hour before her statement came out, we did see with the PCE numbers coming in lower than expected. Now, the question is that going to continue? CPI was obviously not great last time, and so she has a position. We'll see if it continues and if other people join with her in it. It's interesting. You look at the dot plot. I think we have that here for 2024, the one that just came out. And it shows, if you look at the upper left-hand side, you can't really see it very well there, but basically what it shows is there were 4 people, one of whom presumably was Hammack, who thought they should not cut rates.
Yeah.
So she's not alone, and that means we're going to have probably more disagreements as we go forward into the coming year.
Well, that's what I wanted to talk about, because this was the first dissent by a regional bank president since June 2022, and it felt like for a while the Fed was really unified, really sort of voting in lockstep. Now you're starting to see some drama, and as someone who roots for chaos, should we be expecting more of these not only dissents but public dissents?
Well, if you consider what we've got, chaos, then you'll probably be happy in 2025 because we're going to have a lot of we're already starting to see the speeches and commentary come out after this last meeting. We'll see more of that once the year begins as we get closer to the next meeting, and you'll see people taking different positions. The question is going to be who's going to be the center of it all, and I would watch for, obviously, if we hear something from Jay Powell, John Williams, who was on CNBC today, basically saying he's undecided, and then somebody like Chris Waller, if he speaks, watch those more than the others, because if they are for a rate cut or for a pause, that's probably what the committee will do.
Now, I believe she said also that in her estimation that we're getting closer and closer to that neutral rate. What did you make of that commentary in the dissent?
Well, she said that before the meeting when she made a speech and suggested we're getting close to a pause. The problem is nobody knows what the neutral rate is. The estimates are between 2.5% and 4%. So she's obviously on the 4% end. We're at 4.25 now on the low end. So we don't have very much farther to go. And that would suggest one rate cut. But others think, John Williams thinks it could be as low as 2.5%. So we could see, with that debate, no resolution. And that gives them reason to keep cutting if they think it goes farther.
All right, a lot to look forward to in 2025 on the Fed Watch front. That is Bloomberg's Mike McKee. Have a great weekend when you get there. Meanwhile, let's take a check on the stocks right now. Of course, 25 minutes into the session, you can see we're still lower on the day, but not as low as we were pre-market. The S&P 500 down by about 0.3%. Big tech leading the way lower, currently off by about 0.5%. The small caps making a run for it, up about 0.3%. We'll keep our eyes on the Russell 2000. Now, coming up in our next hour, we'll be joined by Jim Rowley. He is the CEO of Crunch Fitness. He's joining us to talk about New Year's resolutions. Don't go anywhere. This is Bloomberg.
build this facility, which is part of your $2 billion investment in the last 2 years. It's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this
Yes.
facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Lawmakers in Washington have a busy day ahead as the nation inches closer to a government shutdown at midnight with no new spending plan in place. Reporters caught up with House Speaker Mike Johnson last hour.
Is there going to be a different bill on the floor today?
Are you going to vote today? Yeah, we're expecting votes this morning, so y'all stay tuned. We got a plan.
You reached a new agreement?
We'll see.
Last night, lawmakers rejected a package approved by President-elect Trump. Correspondent Scott McFarlane is on Capitol Hill.
No matter what you want to do, no matter what the plan, like it, love it, you need dozens of Democrats and dozens of Republicans to get on board. So one party coming up with something they like is never going to be sufficient.
As we head into the holiday weekend, winter weather is slowing travelers down, but not everyone's complaining.
The first big snowfall of the season has hit much of the upper Midwest. Tom Morton was out enjoying it in Minneapolis with his black lab puppy.
Constantly running around in circles, absolutely loving it. It kind of brings you back to being a kid yourself, running out there and wanting to go sledding and whatnot. It's kind of where it brought it back to right away.
Snow advisories are posted today for parts of Michigan, western New York, and the southern Appalachian Mountains. Jim Crisula, CBS News.
Correspondent Chris Van Cleve is monitoring air travel from SeaTac International.
Folks getting a very early start here in Seattle. It's going to be one of the busiest days of this travel period. The TSA expects about 2.8 million people to pass through airport checkpoints. But there is weather going on, so we are watching for the potential of delays, even in San Diego and Los Angeles, Chicago, and then from Philadelphia all the way north to Boston.
One of the Fed's key inflation gauges was up just a touch last month. It rose at a lower than expected rate of 2.4%. Business analyst Jill Schlesinger.
Although the Federal Reserve has made great progress in bringing the inflation rate below 3%, getting from 3 to the Fed's 2% target remains elusive.
Starbucks customers in several cities are being forced to skip their iced sugar cookie lattes this morning. CBS's Stacey Lynn.
Workers in L.A., Chicago, and Seattle are walking off the job after stalled talks over pay and other benefits. The strikes are expected to expand through Christmas Eve, with hundreds of locations across the country joining.
Paul and Ringo were back together again in London. McCartney brought his former Beatles bandmate onto the stage to play during his gig at O2 Arena last night. Rolling Stones guitarist Ronnie Wood joined them too. It was the last stop on 82-year-old Sir Paul's Get Back tour. The Dow down 8. This is CBS News.
Love.
40-year-old skiing champ Lindsey Vonn makes her comeback tomorrow.
The World Cup event is in St. Moritz, Switzerland.
She is in the lead, and the lead is huge.
9 years ago, Vonn topped the podium.
Lindsey Vonn wins again. Back-to-back Super G wins.
She's set to race in the Super G event tomorrow and Sunday. Her personal coach says she can be competitive. She's not that far away, is how he put it. She can push a lot harder. Vonn's last major race was nearly 6 years ago. Crashes and injuries prompted the three-time Olympic medalist's retirement. But now, after recent knee surgery, she says she's healthy. Steve Kathan, CBS News.
Sources tell People magazine King Charles will continue cancer treatment into the new year. The outlet says aides have signaled the 76-year-old monarch has been under medical care since his diagnosis almost a year ago. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube. Alex Steele, she bailed on me after 3 hours of radio. Apparently she has to do some TV show. Not too worried, because Norma Linda, Bloomberg News, she's our markets person. We've roped her in here for the next couple hours, so Nora's going to help us kind of get through and take a look at these markets. Again, the markets have kind of come back. They were selling off in the futures market pretty steady right now. We're going to check in with Alex Semenova. She'll break down the markets for us. Nathan Dean, he's a Bloomberg Intelligence policy analyst down in D.C. He's on top of this negotiations about this government and whether we're going to shut this thing down over the next 24 hours or so. So we'll check in with him. Christopher Smart, managing partner at Arbor Oath Group and former special assistant to the president for international economics on the impact of potential government shutdown. Michael McKee, he covers all the economics for us here, and he'll join us as well. Poonam Goyal, she's going to break down Nike's numbers for us. They had some earnings out. I'm a Nike person. I think their shoes are just the bomb, but we'll break it down. Let's go to Lisa Mateo. I'm not sure what she does in all her work. She works out like every day, although I think today's her rest day.
Today is Friday. It's
but
the rest day.
Who knows what she does. Lisa Mateo, she's got a Bloomberg Business Flash.
You got it. This Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Well, we've got stocks mixed, and this is after the Fed's favorite inflation gauge cools. We're talking about core PCE increased 0.1% from October, 2.8% from a year earlier. The monthly advance was the slowest since May. Now, that report also showed healthy increases in incomes and spending. Out now, we have a read on sentiment from the University of Michigan. So so let's get right to it. The expectation was for 74.2, came in a little bit higher at 74 even. All right, let's get to the markets now. We have the NASDAQ down 0.3%, 70 points, 19,300. The Dow, little changed, up about 3 points, 42,345. The S&P 500 down 0.1%, 8 points at 5,858. The 2-year yield, 4.28%. That's down 3 basis points. The yield on the 10-year, 4.51%, and that's down 4 basis points. The Bloomberg Dollar Spot Index down about 0.3%. Let's get the shares of Novo Nordisk. They're down lower this morning, about 19%. It said patients on its experimental obesity shot lost less weight than predicted in a study. That has shares of Eli Lilly, though, higher, up about 5%. And FedEx, they announced plans to spin off its freight division into a separate publicly traded company. Wall Street kind of likes that idea, but now things are starting to change. We're seeing FedEx dip a little bit lower, down about 0.5%. And Nike posted an earnings beat, but its new CEO did say its turnaround efforts might hurt earnings in the short term, so its shares are down more than 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Alex Steele, she's off doing the TV thing right now. Nora Melinda's sitting in for Alex. Nora, what are you looking at here? We had some kind of a volatile week in your equity markets, didn't we?
It's been a crazy week. I cannot believe that it's only been 5 days because we've been all over the place. I mean, after we had that Fed cut, and then we heard the Fed saying that things could look a little bit differently moving forward in terms of how people are pricing in rate cuts moving forward. We saw a huge sell-off, and then today, as I'm looking at stocks, okay, well, we're down a little bit right now, but we were in the green just a second ago.
Yeah, it's been a wild week here. Again, the Fed kind of really front and center here. Let's see where some of the action is under the hood. We do that with Alexandra Semenova. She's the equities reporter for Bloomberg News. Joining us here in our Bloomberg Interactive Broker studio. Alex, what are you looking at?
Great to be on with you guys. Happy Friday. So I was taking a look at FedEx all morning, and very interesting. I'm seeing a little bit of a reversal right now. Initially in pre-market trading and earlier in the session, it was one of the only bright spots, up more than 2%. Now it looks like the broader market is kind of pairing its losses, and we're seeing FedEx actually lower. This is after the company said that it plans to spin off its freight division into a separate publicly traded company. This is in a deal meant to streamline its main business. FedEx said Thursday that it will separate this unit within the next 18 months. Bloomberg Intelligence estimates it has an enterprise value of more than $30 billion. Now, I think the reaction here is because of what analysts are saying. Loop Capital says that regarding the spin, there is still an element of uncertainty regarding corporate overhead costs. So this is going to take 18 months, and it seems like Wall Street analysts don't really like that. Not a lot of clarity around what this will ultimately look like.
For sure, and on the analyst for JP Morgan's also saying that the spinoff is not yet priced in for the stock. Exactly. So it'll be interesting to see how that all trickles out, to your earlier point.
Exactly.
I like spinoffs. They're usually a good thing. Because my banker buddies get paid and the lawyers get paid. Novo Nordisk, what's going on there?
That's, of course, one of the big stories today. It was down as much as 29%, erasing more than $100 billion in market value. This is, of course, after patients said that its experimental obesity drug saw them lose less weight than predicted, only about 20.4% of their body weight in 68 weeks compared to the 25% weight loss that Novo had predicted. So you can see it's not a huge difference.
Right. I don't get it.
But because competition is so hot in this obesity drug market, the second that there is any kind of disappointment, investors will
But I don't know. I mean, I know a patient who was on Wegovy, and she has lost 22% weight in, 6 months. I kind of think that's it. That's kind of the numbers people are talking about.
Exactly. It's in that range. But again, traders, who have seen the stock run up so much, any kind of minor, downside surprise to expectations will really
see some pressure.
Yeah.
See, if I'm a shareholder, I'm buying hand over fist today. That's how good I think this company is. And you see days like today. Again, I read that data and I said, a little bit off.
Yeah, well,
and maybe if you give me a 3, 4, 5% sell off. But
a really interesting thing too, though, is Eli Lilly is a beneficiary of this. Of course, they've been neck and neck with the competition. Right. Eli Lilly is rising on the disappointment. Mizuho said that this result is giving an edge to its competitor.
All right, Alex, thank you so much for joining us. Always appreciate getting your reporting. Alexandra Semenova, she's equities reporter for Bloomberg News. Let's turn to Washington, D.C., because that's where the action is, folks, at least until midnight tonight, and then maybe even through the weekend, and we'll see there. So we're going to check in with Nathan Dean. He runs all of our policy stuff for Bloomberg Intelligence out of Washington, D.C. What does that mean? We have a bunch of experts down in Washington, D.C. for Bloomberg Intelligence, and they follow policy, they follow litigation, everything associated with your government and how it impacts industries, businesses, and they're really some smart folks. And at times like this, when we're talking about the governments and shutdowns and budgets and stuff like that, I don't know what's going on down there. So we talked to Nathan Dean. He knows what's going on. Hey, Nathan, have you fixed this thing yet? I'm putting all my faith in you. Where are we now with this potential shutdown?
Yeah, so we're in a situation where there's a lot of ideas being floated around Capitol Hill. You know, just 2 hours ago, there was this idea of a 3-week stopgap solution. It certainly could come back. One of the ideas that we've just heard is potentially breaking up this continuing resolution into several bills. One continuing resolution, one farm bill, one debt ceiling, and so forth like that, and then have individual votes. But I think what Speaker Johnson's trying to do at the moment is trying to figure out, A, how do I keep the government from shutting down? He does not want to have a shutdown occur over the holidays. And B, also remain true to what President Trump's ultimate goal is at this point, and that is to get the debt ceiling resolved before January 20th. There's a lot of ideas, a lot of floats out there, a lot of options and so forth, but we're still sticking to this 40% chance of a shutdown by Monday. Even though I know the government shuts down tonight, Congress could take the weekend to figure it out before government workers can't go into the office on Monday morning.
Nathan, the U.S. is unique. I mean, other countries don't do this whole thing of a government shutdown. So let's take it a step back. What exactly is a government shutdown, and what are the implications of it?
Yeah, so this is essentially because Congress fails routinely to pass an annual appropriations bill. And when that happens, they have to do what's called a continuing resolution to keep the government funded. Now, if the government does shut down, all non-essential government workers cannot work. They're furloughed. Now, they do get the back pay, usually retroactively every single time this has happened. The back pay comes, but you see a lot of essential services, non-essential services grind to a halt. You won't be able to go to the museums in D.C. this weekend. You won't be able to get your visa processed for the passport. But there's also other impacts, like the TSA, while they're working, when this has happened over the holidays before, a lot of them called in sick. And so if you're traveling next week and the government shuts down, you certainly want to give an extra time at the airport. But ultimately, government shutdowns are not good politics. The party that causes the shutdown ultimately is the one that pays the political price. And look, it's easy for President Trump to say that he wants to shut it down right now. He's got 4 more years. But there's a lot of House members that barely won their constituencies over the election. They certainly don't want to see their popularity go down at the same time that they're trying to push forward President Trump's agenda next year.
Nathan, you mentioned that non-essential government workers would be affected by this. Who are considered essential? What can still be counted on in the event that there is a shutdown that occurs?
Yeah, so things like Social Security, Medicare, Medicaid, mandatory spending, that all continues. There's really no impact from a shutdown like this. Usually Department of Defense, CIA, FBI, they're essential. Even the U.S. congressional gym is considered essential just because Congress folks love to use it during shutdowns. But what is non-essential is if you think of an agency like the Securities and Exchange Commission, well, they're not going to be doing any policy work here. There's not going to be any new rules, new regulations. There's still going to be somebody monitoring the markets, but an enforcement action is probably not going to happen just because the BlackBerries get turned off, the emails get turned off, and you can't enter the office. There's no work that you can do other than the bare bones of keeping the government operating.
Nathan Dean, my Bloomberg news feed is full of news about President-elect Donald Trump and some other civilian named Elon Musk. I'm not seeing anything from my president, your president, our president, Biden. What's going on there? What's the word down in D.C.?
Yeah, so if you talk to the Democrats, they'll say this is a Republican problem. I mean, we saw Vice President-elect J.D. Vance last night just blame the Democrats for the failure to get the debt ceiling vote going forward. But ultimately, this is a Republican issue. 38 Republicans voted against President Trump's desires with that package. And so there's no unity at the Republican side. So what President Biden and Hakeem Jeffries and Chuck Schumer are doing at the moment is they're essentially just saying to the Republicans, look, we're not going to help you right now. We're not going to bail you out. You have to figure out what the plan is. Then you'll come to us, and then we'll see what we can do.
All right, that's how it works. All right, Nathan, I'm depending upon you. You're the only sane guy I know down there in Washington, D.C. depending upon you to get things fixed down there. Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. It just seems, Nora, we get to this, I think it's almost like an annual basis.
Right.
These, government shutdowns, threats of shutdowns. We had, certainly during President Trump's first administration, we had a couple of shutdowns. One was, I think, 35 days
35 days was the longest one we had.
So it's becoming, I guess, a more normalized part of governing with the stark divide, the even, it's 50-50 pretty much in the Senate and the House almost. That's, I guess, what you end up with.
Narrow margin, for sure.
Yeah, so we'll see. Again, midnight tonight, or as Nathan suggested, maybe they'll push it a little bit over the weekend because I guess the key criteria will be Monday morning. Will the government be open for business? The markets mixed. We got red and green on the screen here. The S&P up about 3 points, the Dow up 100 points, NASDAQ down 29 points. Coming up, we're going to check in with Christopher Smart, managing partner at Arbroath Group and former special assistant to the president for this government shutdown.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks mixed, and this is after a revised funding plan fails a House vote. Right now, NASDAQ down, well, it's little change, down about 15 points at 19,357. The Dow up 0.2%, 116 points. And we have the S&P 500 little changed, up about 4. The 2-year yield at 4.28%. That's down 3 basis points. The yield on the 10-year 4.51%, and that's down 4 basis points. We head over to commodities. We have Brent crude at $72 a barrel, WTI crude $68 a barrel, and spot gold up more than 1% at $2,625 an ounce. The Bloomberg Dollar Spot Index down about 0.3%, and Bitcoin down nearly 1% at just over 96,000. Shares of U.S. Steel, they're down nearly 5%, and this is after it warned its fourth quarter earnings will be lower than anticipated. And then you have shares of Winnebago Industries, they're down 3%, and that's after the company turned in disappointing earnings. Sales, looks like demand for RVs just isn't as big as it used to be. And then Carnival, on the flip side, it swung to a profit. Revenue climbed higher in the latest quarter. The company said it expects travel demand to continue into 2026. Its shares up nearly 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash. Paul and Nora.
All right, Lisa, thank you very much. We appreciate that. Nora Melinda sitting in for Alex Steele here today. I'm Paul Sweeney. We are streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast. We're also doing this whole live thing from the Bloomberg Interactive Broker Studio here in New York City. The government shutdown is a thing, and we kind of getting used to it, I guess. It seems to happen at least once a year these days. But let's put this whole thing in perspective and how the next several days might unfurl there. Christopher Smart joins us. He's a managing partner at Arbroath Group, and he's a former special assistant to the president for international economics, joining us from Boston via that Zoom thing. Hey, Chris, thanks so much for joining us here. I guess, again, we've all in this market become, I guess, kind of used to these threats of government shutdowns. What's a little bit different this time is we have a couple of civilians that are really weighing in and almost driving part of the conversation. That is President-elect Trump and Elon Musk really involved here. What do you make of that whole dynamic? Because that seems a little bit unique.
It seems very unique. I'm not sure we're supposed to add modifiers to unique, but it is a very different rhythm from the traditional government shutdown background music that many investors are used to at this time of year, along with the Salvation Army bell ringers and anybody singing carols at your door. There is always the drama of when Congress will go home, will there be a budget, or will there be a continuing resolution, and what services may or may not get shut down for a few days. As you say, the difference, one big difference this time is we have a president-elect who's not really president, scuttling what had been agreed by all sides earlier this week. We have, as you say, a civilian, somebody who's not even headed for a government role, an official government role at least, who's also sort of driving the dynamics on social media that we haven't really seen anywhere in the past. Then I guess to me, the third thing is, from the market's perspective, there's one thing that the markets always hate, which is the debt limit debate that comes up from time to time and the threat of the United States defaulting here. The fact that President-elect Trump has sort of introduced this as one of his asks in the continuing resolution, or at least that's what it's been in the last 24 hours. We'll see how that evolves. But markets would love to see this thing go away. The problem is getting the math to work on that particular part of an already complicated bill becomes very, very difficult.
It feels like in markets, we have so many things to worry about right now. Honestly, my eyes are on so many different things right now, especially with this being a Fed week. But of course, this is a concern as we're thinking about the uncertainty that could be upcoming in this situation. What is the impact on markets here historically? Do we really care about a government shutdown in terms of the near term?
I think probably less so this time around. First of all, the sell-off that we've seen this week was squarely linked to the Fed's statements and more hawkish music coming from that part of Washington. If we were sort of really on the verge of a recession and you worried that government spending would be cut off and government activity would tip the balance into a recession, then I think markets would be paying much closer attention to what's going on right now. But you have an economy that is on the margin running a little bit hotter than the Fed would like. And, from a macroeconomic perspective, a little bit of cooling, even if it comes from a shutdown, is probably not a bad thing overall. obviously from a governance perspective, from a predictability perspective, from a political perspective, it's never a good thing when you have it this kind of dynamic in the background. And I think the thing around these government shutdowns, is that once they happen, it's never clear if it's going to be a quick one or a long one. And once sides start digging in, this could go on well into the new year.
So again, we were just talking with one of our analysts at Bloomberg Intelligence who covers the Washington policy, and he had raised his risk of a shutdown or odds of a shutdown to 40%. That's up from, I think, 20 or 30% just a day or two ago. My sense is you feel like it's maybe even higher than that here. What's the politics of a shutdown here? How would you view the politics of a shutdown that might go through the holidays?
Well, I'm not sure anybody benefits from a shutdown, but the question is always, can you blame the other person more? And obviously, I think at this stage, it looks like this has been a shutdown that's been triggered by Elon Musk and Donald Trump scuppering this late deal that the Republicans and Democrats had agreed to. Having said that, President Trump just won a big election. It's very easy for him to write the narrative that this is Washington insider backroom dealing that he is fighting against and has promised to eliminate in Washington. So I'm not sure. I think both sides feel like they've got the upper hand here, which I think, as you say, leads me to believe that the odds are maybe higher than 40%, although, these things tend to change very quickly from 1 hour to the next. It just doesn't seem to me that anybody's got a real reason to compromise at this stage. The one minor deadline that's coming up is actually the president's inauguration. Does he want to be sworn into office with the government still shut down? But between now and then, I'm not sure what's going to force one side or the other to come to the table.
When we're thinking about the market, what sectors in particular could be potentially exposed to the impact of a government shutdown?
Again, if it's shutting things down for a week or a month, even 2 months, the macroeconomic impact is fairly limited. Obviously, you can see government contracts that don't get written, maybe defense contracts that don't get done this year or get pushed into next year. You get a lot of uncertainty, that maybe some businesses aren't planning their investments the way they would like to, given the uncertainty around government spending. But the real questions are not so much around the shutdown itself as I think everybody is looking to both the tax debate that's going to come into line very quickly and what sort of differences they can expect in terms of corporate taxes and potential rollbacks of President Biden's subsidies to the automotive, to the electric vehicle, to the clean energy industry. And then the other piece of that, I think, that is driving things are the tariff wars that are building up.
Christopher Smart, thank you so much for joining us. Chris Smart, he's a managing partner at Abroth Group, former special assistant to the president for international economics. Just giving us his thoughts here on the potential shutdown. I think, as Chris was just mentioning, he kind of feels like this is something that may come to fruition, so we'll have to see. We'll pay attention to that starting midnight tonight. I will be asleep, but I'm sure the lawmakers hopefully will be working up until that midnight deadline. Let's move over to the economic data. We had some, if you go to EcoGo, a lot of economic data today, particularly on the inflation front. We had the PCE data, which is the inflation print that the Fed purportedly pays a lot of attention to. Michael McKee joins us. He covers all the economics for Bloomberg here. He joins us here in our studio. So, Mike, I'm looking at the core PCE year to year, 2.8%, flat with the last month, a little bit less than the 2.9%. Well, that seems pretty good to me. I mean, that's okay, right?
You're ready to call it a year.
I'm an easy grader.
Yeah, easy grader.
Ready to wrap it up.
Move on. I think that, yes, it's not bad. We're in the range, but it's not 2%. The Fed said we would get 2%. The year-over-year numbers have gone up a little bit this last month in November, largely because of base effects. But the month-over-month numbers were good. They were 0.1% both for the headline and the core, which suggests that the inflation picture is improving. I mean, we're looking back 12 months when we're looking at the year over year, but the most recent month did show some improvement, and we had not seen that in the CPI or PPI, so this is good news for the Fed.
I mean, as we think about this, has been a really busy week. I was just saying this a little bit ago, but I mean, we had the Fed cutting rates by 25 basis points this past Wednesday, and of course that was largely expected, but it was of course the comments that he made after the decision was released that had the markets a bit in turmoil. And so how are we really thinking about the PCE data? Is it changing the narrative at all as to how the market has been viewing Powell's commentary over the past few days?
It changed it a little bit. We saw, market reaction. We saw yields come down. But I think what people are going to be looking for is backup to this. I mean, we had one good month. We've had like 3 where inflation was generally stuck. So we'll be looking at CPI next month to see if there's improvement in that. They're particularly at the Fed looking for improvement in owner's equivalent rent, the housing measure. It did finally break down to just a 0.2 rise, the kind of thing that the Fed was expecting for months and months that hadn't happened. So if we get more of that, that would be also good news. And they want to see what happens with the labor market at the same time. If the labor market weakens and inflation comes back down, then people will start putting January back on the table. Right now, nobody expects them to do anything at the January meeting.
So what components are still sticky at the moment?
Basically, in this latest numbers, food was the one that went up both for the CPI and for the PCE. Energy went up a little in the CPI and down in the PCE. So it depends on how things are measured. But basically, there hasn't been anything you could necessarily say is the one cause of it other than housing. And so if housing is coming down, that's going to be good news. Otherwise, we're seeing some months things up, some months things down.
Hey, Mike, 30 seconds left. Is it inflation or is it labor that the Fed's really focused on now, or both?
Well, that's an interesting point, because the Fed had made the case that labor was the most important thing when they kept rates low, and then they made the case that we might have to cut rates because we were afraid of the labor market weakening, and now they're very happy with the way the labor market is, and we've switched back to inflation. So inflation is the main indicator that they're going to be looking at.
All right, we'll keep our eye on it. Lots of economic data coming up. ECO Go is the function to keep in line with what's happening on the economic data front. Again, inflation data came out today. I think pretty good data. It feels good to me. Again, maybe I'm an easier grader, but we'll go that way. Michael McKee covers all the economics for Bloomberg Television, radio, pretty much everything else in between. Appreciate getting a few minutes of his time. Looking at the markets, we've turned higher, kids. The futures were really negative, and now we've got the S&P up 0.7%, the NASDAQ up about 0.6%, and the Russell, the small cappers, up a little more than 1%, so we're broadening out on this market. Keep an eye on that. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we've got a lift to the markets now, and this as investors assess the outlook for the economy and also for the Fed's rate cuts for next year. San Francisco Fed President Mary Daly said she is, quote, very comfortable with policymakers' median projection of 2 interest rate cuts next year. So let's head to the numbers. We have the NASDAQ up 0.7%, 136 points. The Dow up 0.7%, 312 points. And the S&P 500 up 41. The 2-year yield at 4.28%. That's down 2 basis points. And the yield on the 10-year, 4.51%. And that's down 5 basis points. To currency, the Bloomberg Dollar Spot Index down about 0.3%. The Japanese yen up 0.5% at 156.63 against the dollar. The euro up 0.3%. Same for the British pound. And Bitcoin right now, it's down just a fraction at just above 97,000. Few companies making news. It's Foxconn reportedly pausing its pursuit of Nissan while Nissan negotiates a potential tie-up with Honda. Now, sources are saying Foxconn wants to hold off to see if those two companies get a little bit closer to a deal before it starts to make a move. And you may have to wait a bit longer for that Starbucks latte. The union representing baristas plan to strike for 5 days, starting today in stores across Los Angeles, Chicago, and its hometown of Seattle. And Boeing wins a $36 billion deal from a Turkish low-cost airline, and that's a bit of a blow to Airbus, which was its previously preferred choice. For on-demand news 24 hours a day, subscribe to Bloomberg News now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. And Alex Steele, like, she's not, like, working right now. She has TV this afternoon. I just saw her up on the 6th floor having a snack. I'm like, dude, you couldn't do this in the studio?
A busy woman.
I
a busy
know.
woman.
She does a ton. She does radio and TV. So she's getting ready for a TV gig here. But so we're here. We're here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. I'll tell you, I've said this a million times. I could never be a healthcare, pharmaceutical, biotech analyst, investor. These stocks just rip left and right, and I have no idea what. Like, so Novo Nordisk comes out and says, I guess their experimental obesity shot, CagriSema, another stupid name. I mean, patients lost 20% of their weight over 68 weeks. To me, that's good. I don't know what but apparently not good enough. Stock down 20%. And this isn't like a small cap penny stock. This has got a market cap of $2.6 trillion.
Exactly.
It's crazy. So I'm glad I don't have to do it. John Murphy, he does it. We pay him to do this stuff. John Murphy is our senior pharma analyst. And anytime we don't have to talk to Sam Fazeli, that's a good day. So we talk to John Murphy on this pharma stuff. Hey, John, I don't know. Talk to us about the expectations for Novo Nordisk and this weight loss drug, the expectations and what they actually delivered.
Yeah, thanks very much. Thanks for having me. So I think one of the issues here, as you rightly said when you opened there, 20% weight loss is fantastic, right? I think for the majority of people who look to take a weight loss drug, that would be beyond their dreams, and it certainly would be on the wildest dreams of most people 3-4 years ago. The real issue here, however, is that there are drugs out in the market already that already give that, and in particular Lilly Zepbound. And so this was Novo's product to come out and beat Zepbound. And Novo had been very, very vocal, extremely vocal at telling the market, we're looking for 25% weight loss. That's our level. And that was reiterated time over time. So that's what people were baking into their expectations.
Okay. So it sounds like they were being quite ambitious in terms of how they expected their things to come out, but then of course they're missing here when those are the expectations that Wall Street had for it. Who's winning the race right now? It sounds like Eli Lilly is the front runner here. Is that so?
Yeah, I think they are. I think it's well accepted both by the street and also by doctors whom we survey that Zepbound is more effective than Wegovy, and so therefore it is winning the race. As I said, this was supposed to be the answer from Novo. It didn't make it. But let's not think about this as being totally black and white. It never, ever is when we're dealing with obesity. The game is not over by any means. And I do want to point out, for example, that third quarter next year, we got a head-to-head study. So Novo's got a study where it's putting its CagriSema up against Zepbound. So CagriSema, the drug today that came in below expectations, going head-to-head. That's going to tell us an awful lot more. There's also issues in this study today, by the way, in the trial design that makes people question some of the data, and they may well actually rerun this study.
So when I'm looking on a year-to-date basis, we have Novo Nordisk shares down 21% year-to-date, but Eli Lilly shares are up 36% this year. For Eli Lilly, I want to know how much of the business is focused on weight loss drugs, and the same for Novo Nordisk. Why are we seeing Novo Nordisk shares down so substantially in comparison to their competitor Eli Lilly here?
So let me answer the second one first. If you look out to 2030, the market had $15 billion in for this drug, and it's basically more or less just wiped that out today. And I think, as I mentioned, there were very high expectations going in. And so there was a bit of a pair trade going on in the market with people being long Novo versus Lilly. So obviously that went out the other way today. I would turn it a slightly different way and answer it slightly different. Look at where the growth is coming from going forward. Not just the sales, but where is the growth coming from? And for both companies, essentially all of it is coming from weight loss and diabetes. So it's coming from these GLP-1 drugs and or their successors.
All right. As someone who likes to jab other people with this weight loss drug, which I do on a weekly basis, and it's a lot of fun, we make an event out of it, when is the oral form, the pill form, when is that coming? Because that could be, I think, the next leg up, I guess, in just kind of the uptake in this treatment.
Right, yeah, that's right. So we already have one on the market, not particularly effective, and that's Rybelsus from Novo. Novo's also got an oral semaglutide, which could come over the next year or two, but that itself has its own issues. So you're then looking at the Lilly one, orforglipron, and orforglipron, which you see about 12 to 14% weight loss on. We're getting data on that next year, so that could be on the market potentially the year after. And as you rightly mentioned, that could be a real significant game changer, not only in terms of the absolute weight loss there, although some people prefer to be injected, one injection a week as opposed to taking an oral pill. But the other thing it might do is it might have a big impact on weight maintenance. So let's say you lose 15 to 20% weight. With the injectable, you then move on to the oral, and that maintains the weight loss. Because what we see at the moment with the likes of Zepbound, if you stop taking it, you start piling the weight back on after a given time.
See, Paul, I need to know what day of the week you guys do this jab event.
Oh, it's Friday. It's Friday. Cocktails. We make a whole thing out of it. And boom.
Okay. John, tell me a little bit more about the healthcare industry and how it moves. Are we seeing a lot of these developments already priced into the stock market, or are there some extraordinary developments that can really change the tide of this industry and its progress?
Yeah, so there's a couple of things happening at the moment. I think firstly, if we just focus on data and news flow, data are driving share price. The clinical study outcomes drive share prices. We've seen a lot of data in the last month or two, and unfortunately for most companies, it has been relatively negative. So you've seen a bit of a hit, and you introduced this right at the start, talking about biotech investors. They've had a tough time of things recently. But second, if we just think bigger picture, if we look at the last 3 or 4 presidential elections, it was in the 12 months coming up to the presidential elections where pharma was underperforming, and it was underperformed because of the threat of healthcare reforms. But because of the Inflation Reduction Act, that already set in stone, something that both sides were very, very comfortable with. So healthcare outperformed well ahead of the election. But what's happening now, of course, with the whole debate in the Trump administration, who's going to head up HHS, who's going to head up FDA, what might happen with regard to vaccines, etc. That's where you're seeing issues right now, both in pharma and also, of course, around the PBMs. In other words, what sort of pressure might come on them. So really what we're seeing now, particularly in the US, is reaction to what the new administration may do or is talking about potentially.
All right, Nora, John Murphy here. John Murphy's been on Wall Street forever. He knows what's going on. Or in London, it's the city. He gets his undergraduate degree in biology. Then he gets a PhD, a doctorate in biochemistry. Wow. Just like Sam Fazeli. So what do these knuckleheads do? They're well-educated. Do they go into the lab, help humanity? No. They go on to global Wall Street, and that's what they do. It's just amazing. But John Murphy's one of the good ones. John Murphy, senior pharma analyst at Bloomberg Intelligence. He joins us from London via that Zoom thing. So getting the latest on Novo Nordisk. Again, a big move downward in the stock of that company. And again, $2.6 trillion market cap. But it's this weight loss market is just huge and keeps growing. And you think about it, if you get an oral application or use dosage, you could just open it up to so many more markets around the world. And I've seen some of the research that John Murphy and his team have done on this weight loss market, and it's just absolutely massive all around the world. So we'll keep an eye on that. S&P 500 up 40 points, Dow up 340 points, and NASDAQ up 100 points. That's about 0.6%. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we have Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so go over to youtube.com and search us out there. Looking at FedEx, they had some numbers out there. They cut guidance a little bit. The stock's kind of hanging in there, though. It's kind of flattish today, up about 9.5% year to date. So I don't think the market's really bought in on kind of where the shipping business is going again. But they had, they cut their guidance, so a little bit of a concern there. But let's break it down, and we can do that today with Lee Klaskow. He's the senior analyst. He covers all the logistics and transport stuff, the rails, the trucks, the air freight, all that stuff, the shipping. He's at Bloomberg Intelligence, joining us from Princeton. Lee, what was your take on these earnings from our good friends at FedEx?
Yeah, so the earnings were definitely mixed. They have a lot of well-telegraphed headwinds during this fiscal year of theirs. Some of that is the loss of the U.S. Postal Service contract. Some of it has to do with fewer operating days and just higher costs in general. But they're able to kind of offset those through a couple of initiatives, strategic initiatives that they're working on. Something that they call Drive and Network 2.0, and those should deliver significant cost savings, which when volumes do inflect positively should really have a positive impact on the margins. The parcel business actually did pretty much in line with expectations, slightly better, but the freight business, it's less than truckload business or LTL business, was somewhat below expectations on a volume shortfall.
All right, as a former banker, I love a good spin-off here. Tell us what FedEx is doing with their freight business.
Yeah, so FedEx Freight is their less than truckload business or their LTL business. It's the largest LTL carrier in North America.
Really?
What they've decided to do, and again, around 6 months ago, they said that the business was under strategic review, is that they were going to spin it off or do something with it. We thought a spin out was the most appropriate action. The fact that it's the largest carrier, we couldn't see them, one of their peers buying it. That just wouldn't really make much sense. We thought that possibly a strategic buyer could be like a Maersk or a DSV, both European-based transportation companies that are looking to diversify their businesses. But a financial buyer really didn't make terrible sense because it's not like a story where there's a lot of room for improvement on the margin side. They don't have the lowest margins in the industry. That's Old Dominion. There's about 800 basis point difference between the two. But it's not probably compelling for a financial buyer. So we just thought that, the probability was that it was, if they are going to get rid of the business, it would be through a spin. And the reason why they're doing it, it's going to unlock a lot of value. LTL carriers trade at a much higher multiple than FedEx is currently trading at. And so that's one thing. And also it'll allow management to really focus on its parcel business, the business that's left over, which is a lot larger. FedEx Freight accounts for maybe 10% of revenue. And the parcel business is evolving. It's been changing rapidly, with the advent of e-commerce, the B2C business, which is pretty much home deliveries, is a much more complicated delivery for FedEx's and UPS's than a B2B delivery, which is going to a law firm, because there's a lot less density and the cost per delivery is a lot higher. So what they're trying to figure out is how can we lower that cost to deliver. And what we would say is that they're making strides, and some of that is fogged over by the weak demand.
Lee, okay, so FedEx is often considered to be the quote-unquote barometer for the economy because its shipping volume typically directly reflects the overall health of business activity and consumer spending. What is this latest earnings report telling you about where the broader readout of the economy could currently stand and just broader corporate demand when it comes to shipping?
Yeah, so I think there were some positives and negatives in the reports and some of the commentary to answer that question. They did note that December was stronger than what they thought it was going to be. So peak season has been, I guess, better from a volume standpoint and a revenue standpoint. So that's kind of good news. The reality is, though, is that they are still facing headwinds from a relatively soft economy. You know, they did note that Asia could be a little softer in the coming quarters ahead. So, you know, I think what we're seeing is a somewhat resilient consumer, but not necessarily a robust or strong consumer that's rushing out and buying a lot of things. You know, the consumer has been resilient through this last cycle. I don't even know how far back we're going to go. Maybe from the pre-pandemic, they've been pretty resilient, and that resiliency looks like it's continuing.
All right, Lee, thank you so much. We appreciate that. Lee Klaskow, he covers all the logistics and transportation stuff for Bloomberg Intelligence. Of course, when I see a spin-off deal, I look, who of my buddies on the street are getting paid? This time, Goldman Sachs is serving as a financial advisor to FedEx, while Skadden Arps is providing the legal counsel. Know folks at both shops, and good for them. FedEx is a great customer. LTL, do you know what LTL means?
Tell me.
Less than truckload versus
Okay.
truckload. A truckload is you take a truckload of goods from point A to point B. Less than truckload is you could put a little bit less than a full order into your truck, but then you'll go to somebody else and get more, put that in your truck, go to
Okay.
someplace else and put more of that in your truck, and then take it to a spot. So less than truckload.
Well,
That's
there
the
you
kind
go.
of the backbone of the trucking business, is a less than truckload business. How do I know that? Way back in the day,
Niche.
I covered rails and trucks when I worked at Payne Weber and did a bunch of deals and IPOs for the truck companies. I once did a trucking trip for an IPO candidate we were doing, Heartland Express, from the port of Los Angeles to Des Moines, Iowa. It was an overnight trip. We did the truck stop, the whole 9 yards. I was the only banker out of about 30 that raised their hands that said, yeah, I'll do that. It was fun.
And it's paying off today.
It's paying off today. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right. Coming up in this hour, we're going to get the latest on the markets. They've turned higher. I know I blinked and they went from negative to positive. So there you go. Emily Graffeo, it's her job. She'll figure us out and she'll tell us what's going on there. Wendy Schiller, Professor Brown University, will give us the latest on the potential shutdown in this government. It is Friday, which means we talk municipal bonds today with Eric Kazatsky from Bloomberg Intelligence. Laura Davison, Bloomberg News politics editor. Not everything gets shut down when the government stops spending. That's the topic of her article, so we'll break down that with her. I am surrounded by UVA people. It is a tough duty here in the Bloomberg Interactive Broker Studio, but we'll make do. Right now, let's go to Charlie Pell and get a Bloomberg Business Flash. Charlie.
Thank you very much, Paul Sweeney and Nora Melinda, and I want to hear more about that trucking trip. That is wild. The Dow, the S&P, NASDAQ, yes, you mentioned you turn around higher, not just higher, but a lot higher, and the best level of the day right now on the S&P. We're up 44, 59.12. That is a gain of 0.8%. We got the Dow up 386 right now, up 0.9%. NASDAQ up 143, up 0.7%. And yes, a broad-based rally. Small caps, Russell 2000 index up now by 1.3%. The 10-year 4.50%, but the 2-year 4.28%. Gold up $36 the ounce, up 1.4%, 26.30. West Texas Intermediate crude trading lower today, back below 70 a barrel, just above 69 now, 69.08, down 0.4%. And the slide for Bitcoin continues, 96,900 on Bitcoin. It is down today by just about 0.4%. Bottom line, stocks pushing higher into the week's last trading day. In fact, it is the last full trading week of the year. It is also a sign that the sell-off fueled by the Fed's hawkish pivot was perhaps overdone. Now, what about the outlook heading into next year? Tracy McMillian is head of global asset allocation at Wells Fargo Bank.
As we look into 2025, what we see are higher equity markets, and that's based on economic growth that we see a tad stronger in 2025, and that's supporting earnings growth. And then when we look over at the bond markets, what we see there are the potential for higher yields.
Tracy McMillian of Wells Fargo Bank. Again, stocks pushing higher. Best level of the day very briefly after earnings. We do have Nike now down by 1.1%, and FedEx up now by 0.3%. Rival UPS up by 1.7%. And those are some of the top business stories at this hour. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. The market's all over the place. Now we've turned positive. I think it's just because, I
can't keep up.
Emily Graffeo walked into the studio, and now the markets are higher. I have no idea what's going on. Another graduate of the University of Virginia, along with Norma Linda, is Emily Graffeo. She joins us here. She covers all the equity markets for Bloomberg News. Emily, what's going on out there?
That's right. I walked in, stocks moved higher. There are a few micro stories, though, that have been kind of holding the same trade all morning. Eli Lilly is one of them. Those shares rallying up as much as 7%. And I think this is really news about its competitor, Novo Nordisk, because that stock is down as much as 20%. Wow. Worst drop since 2002. Basically, they gave data this morning that their highly anticipated trial of an experimental weight loss drug fell short of expectations. So their obesity shot that helped patients lose an average of 20.4% of their weight, and they had previously predicted that it was going to be 25%. So now their competitor, Eli Lilly, is much higher. And analysts overall saying that, yeah, this is going to be a good move for Eli Lilly, but we'll have to watch because it's all in trial right now.
Yeah, I mean, we just had a guest on earlier that was saying that Novo Nordisk was looking for 25%, and then they came in at 20%. So it could be read as a bit critical, but I mean, of course, when you have that bar and it's missed, that's not what anyone wants to hear. But when we look on a year-to-date scale, we're seeing Novo Nordisk down about 21% this year in comparison to Lilly that you just mentioned, up 35%.
I'm also looking at Nike. This is another earnings story. That stock has also been kind of bouncing around all day. It's currently in the red. It seems like the story right now is that there's going to be a turnaround plan with their CEO, but it could dent short-term results. So their earnings came in, the revenue beat, but it was down 7.7% year over year. Their new CEO, Elliott Hill, cautioning that their efforts may hurt results in the short term. Analysts have kind of been split on this stock. We did have Telsey Advisory Group analyst Christina Fernandez cutting to a market perform from outperform, and again saying that this turnaround is going to take longer to execute, greater investments in areas like brand marketing, and she's going to expect lower sales and profitability over the next 12 months.
What I've recently learned in the sneaker business is that there is real competition to Nike. I am a Nike person, sporting them today.
I was going to say, you're a big
I have
fan.
Brooks on today.
Along with my Duke socks.
They're in my bag at my desk, my Nikes.
You're a Nike person?
I think I'm whatever shoe looks nice and feels
you're not
comfortable.
brand loyal,
but I will say I do wear my Nikes
Emily?
to the gym.
So, well, when I was at UVA, I was brand loyal to Nike because we had a
because you were
we had backing by
dancer.
Nike?
Yes.
Okay.
And that was part of your that was your thing. They outfitted you guys.
They outfitted us in Nike, which was great. But I will say, at least in not so much on sports, but in streetwear, they have not had like a hit product recently.
Okay.
Adidas has had the Samba sneaker. That's been huge. That's been all over the streets of New York City, and Nike hasn't had that like.
What's like? But I see the kids, which I put you guys in that category. The Hoka.
And the Hokas too.
Hokas are comfortable.
Yeah,
I will say that's a comfortable sneaker. But I did hear that apparently Skechers are coming back. I found that out last week.
They do a lot of marketing with
my son goes to college in California, so he's all about the Vans.
Okay.
Oh yeah.
He's got the California
skaters.
Cool thing going on. Yeah, exactly. He's
the vibe.
But VF Corp, I feel like have they been doing well?
I don't know, but I mean, what's going on with Coinbase?
So, okay, again, that was a stock that I was planning to talk about how it was lower because Bitcoin has dropped from above the 100K level to now down to 97,000, but it's higher. I mean, a lot of these kind of speculative area stocks this morning, Robinhood, Coinbase, all part of that Trump trade, were lower this morning. Now they're higher. So this is just going to have to be an area that we watch for the rest of the year.
And I think that reflects what's happened to Bitcoin. Again, Bitcoin's at 97,000 now. It was earlier this morning at 92,000. So it's just all over the place after having reached a high of 107,000 just as Tom Keene would say, a cup of coffee ago. So
it's making me dizzy.
It's kind of all over the place. But again, my call on Bitcoin it's completely uninformed, but I'm going with it, which is I treat it as a commodity. I got this from Mike McGlone, so I'm parroting Mike McGlone's research, and this was from 5, 6, 7 years ago. It's a commodity, so all you have to do is have a call on supply and demand. Mike's call on Bitcoin is relatively fixed supply, and if you believe there's an ever-increasing use case, that's higher demand. It's got to go up. And that's been the call, and I'm sticking with it.
That's what Kathy Wood said on BTV yesterday.
Well, then I'm sure
she
she
has
did.
a target 1.5 million by 2030.
And we're at 100,000 here. So she was on BTV?
She was on Bloomberg Television
I haven't
yesterday.
Seen her. I
she
haven't
reiterated
seen her
that forecast, but she has had this forecast, this above 1 million Bitcoin for a couple years
so
now.
Tesla's rocking, so now she comes out of her, she comes back out and talks. All right, very good. Appreciate that. Emily Graffeo, Bloomberg News, covering what's happening in the world of the stock market here. Again, S&P 500 up about 60 points. That's 1.1%. All that seems kind of moot in the context of maybe our government's going to shut down tonight at midnight when I'll be fast asleep.
That's still going on.
But Wendy Schiller, she joins us from Brown University, and we want to get some informed comments about how this might play out here. So, Wendy, I'm not sure if you're in the business of predicting shutdowns or not, but I'd love to get your perspective on just kind of how the whole process here is unwinding in Washington. We've got a couple of civilians, President-elect Trump and Elon Musk, right smack in the middle of the discussion in the news cycle. And I've got a president of the United States who I haven't heard anything from. So how's this developing?
Well, I think President Biden has ceded sort of the negotiating power of the Democrats to Hakeem Jeffries, who's the Democratic leader in the House of Representatives, and Chuck Schumer, senator from New York, who's still the majority leader of the United States Senate till January 3rd. So basically Biden said, you decide what our position will be, and I'll likely, sign it. So he's ceded all of that negotiating power to them. And I think this is really important for everyone to remember. We have a bicameral legislature. The founders set it up this way on purpose. Two institutions that have very different electoral incentives, very different internal structure, different terms of office. And we're seeing that play out right now. I mean, the Senate's just literally hanging out, waiting for the House to deliver something, and the Democrats control the Senate. So all of this is about, well, if it passes the House, it'll go through. Not so fast. The Democratic-controlled Senate will say, no, we're not going to pass it. So the Democrats have some risk here because they could be party to the shutdown the way the Republicans are. And since it's a divided government right now, it's really unclear for the voters, who are you actually going to blame? Right now, the Democrats have decided they're going to blame Elon Musk. They have made Musk a target of their communications, and you're starting to see a little bit of this creep into some of those Republicans who voted against the package yesterday.
I mean, we just had a story that came out on the Bloomberg terminal saying that House Speaker Mike Johnson is currently strategizing a way to rush a spending bill through the chamber to avoid a government shutdown ahead of that midnight deadline that we've been talking about. I do know that the longest government shutdown in recent history was in 2018 under the Trump administration. It lasted 35 days. If we were to enter into a government shutdown, how do people actually analyze and predict the longevity of how long it could last?
Well, if you're thinking Trump and Trump's strategy, you think, well, if we're going to go into a shutdown, let's shut it down till I get inaugurated. And then, of course, we'll open it back up because at that point, the Republicans will control the House and the Senate. So we'll have more sway. And he's willing to sort of live with the costs that are incurred. Usually, a shutdown of this length usually costs several $billions. Not only in pay for federal employees, but for all sorts of disruptions to all sorts of services that the federal government provides to the economy. So you're going to see a cost here, but then Trump gets to be the hero by reopening the government on his terms. And I think that's the way he's thinking. The debt ceiling is the interesting question here, because the Republicans who voted against this bill yesterday really voted against it because the debt ceiling extension ran through 2027 and basically gave Trump an unlimited checkbook. And they are deficit hawks, and even they were not willing to go there for Donald Trump. So there must be something that they're sensing about how they would face the voters again in 26 that says we don't want to be responsible for blowing up the federal debt and the deficit even more than it is.
I mean, we're sitting here in December. We're still about a month away from Inauguration Day. Paul and I were chatting earlier. How typical is it historically that we have the president-elect implementing and weighing in on these things? Where is Biden and Harris in this conversation? Is this all typical?
I mean, it's we haven't had as brinkmanship, let's say, in December with an election switch. We've certainly had brinkmanship with Ronald Reagan in December, with Barack Obama in December. So you've had sitting presidents have this issue. But the transition in power, I mean, it does really happen, right? I mean, you won the election, you're going to be president. But in terms of the Trump sway of the GOP, that's what we're talking about here, is that it is a wholly owned subsidiary of Donald Trump. But right now, we're seeing cracks in that coalition. And the question is, what's driving those cracks? Is it get rid of Elon Musk? Is it thinking that this is just a bridge too far in terms of federal spending? Or is it they think they'll get some political gain by shutting it down and reopening under Trump with more capital with a Republican-controlled House and Senate? We're just not getting any real signals from the Republicans that matter, meaning the ones that voted against the bill yesterday. But a shutdown is not a way to start an administration. No matter what Donald Trump thinks, it's disruptive. And he's got very high approval ratings now. I'm not sure those are going to go higher by inconveniencing a lot of people over the next couple of weeks.
Wendy, do some people in Washington on either side or both sides of the aisle, do they view President-elect Trump as maybe even a lame duck president? I don't really need to bend over backwards for this guy because he's only here for 4 years.
Well, certainly if you're a senator that was elected in 2024 or even 2022, you're thinking you're probably going to outlast Trump. But then again, lots of people thought Trump might not run again, get the nomination, and win again. Right. I just don't think you can underestimate Donald Trump's political power. But you have an economy that seems to be humming along in terms of growth, and the employment numbers are sort of okay, you know, not disastrous or anything. But inflation is really sticky. And the question is, if there isn't a real change in people's perception of the economy by the summer, I think a lot of Trump's clout could diminish, even among his own base. And then you're looking at the next electoral cycle. So that is where separation of powers is really crucial here. It creates different incentives, and we're seeing those incentives play out right now.
Wendy, I'm curious, do you know the intricacies of what the potential financial implications could be for non-essential government workers? Do they get paid retroactively, or do they just go without pay?
Typically, Congress insists on passing a separate bill to authorize retroactive pay for federal employees that have been furloughed or not paid during a shutdown. So, you know, it varies depending on the shutdown, depending on the Congress. You can see where most people would want to see people paid for work that they do. But if you're not working, then there could be an argument, well, you weren't working, so this is a bloat of the federal government, and we're not paying you for work that you didn't do. The problem with the Republican Party is that the federal government, the civilian force, is large and diverse and spread out all across the country. So in every congressional district, there will be federal employees or people associated with the federal government that will lose income because of a shutdown. And those Congress people are going to hear from those employees. So this becomes very sticky if they don't agree to retroactively reimburse these employees. But remember, the reason that Donald Trump, quote unquote, caved in 2018 and reopened the government was that the FAA and air traffic controllers and sort of our TSA employees, all of that became very difficult for people who weren't getting paid and decided not to show up for work. And that clog in the economy is what pushed Trump to the table. And so that's why it's curious that he'd want to start his administration with another clog in the economy.
All right, Wendy, thank you so much. We appreciate that. Wendy Schiller, she's a professor at Brown University, and she's the interim director of the Watson Institute, joining us from Providence, Rhode Island, versus that Zoom thing. So again, I guess the initial deadline is going to be midnight tonight. Right. So we'll wake up tomorrow, and the government will either be open or not.
Right, I'll be asleep, like you.
Exactly. And then Nathan Dean from Bloomberg Intelligence was saying, hey, that's the deadline, but maybe another deadline to think of is just kind of Monday morning. You know, that's kind of where maybe they can get something done over the weekend, because Monday morning is a time when you got a bunch of federal workers that are about to show up for work.
Everything resets.
And what do you do there? Or do you kick it down? Does President-elect Biden and kind of push the Republican Party to really take a hard line here? So we'll have to see how it plays out. But it seems like we've been here before here. Looking at these markets, moving decidedly higher here. I'm giving credit to Emily Grafeo. I mean, she was
wearing red, but brought lots of optimism.
Lots of optimism. S&P up 1.2%. The Dow, I like to quote the Dow points, up 550 points. That's 1.3%. And the Nasdaq up 233 points. That's 1.2%. And the Russell, the small cap stocks outperforming everybody up 1.5%. And that goes to the balance and the breadth of the market here. You like to see the small and mid-cap stocks, perform in line with or better than the broader indexes to give you a sense that maybe this is broadening out in terms of breadth, which is generally perceived as a healthy move. Bitcoin's even turned higher. Yeah, we're up 0.25%, 97,500 on the cryptocurrency. A lot more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are pushing higher, a sign that the sell-off fueled by the Fed's hawkish pivot was overdone. Right now, we've got the S&P just about at the best level of the morning, up 77. That is a gain now of 1.3%. The S&P at 59.44. The Dow now up 576, up 1.4%. NASDAQ up 259. That is a gain of 1.3%. And the Russell 2000 index of small cap shares up now by about 1.5%. The 10-year at 4.50% with the 2-year 4.28%. Spot gold now surging $31 the ounce, 26.25, up 1.2%. West Texas Intermediate crude just about flat on the day at 69.33 a barrel. And Bitcoin turning around, it is now up by 0.2% with a 97,000 handle, 97,465 on Bitcoin. Novo Nordisk's shares are falling by the most on record after patients using its experimental obesity shot CagriSema lost less weight than predicted in a study, throwing into question the drug maker's ability to maintain its lead in the exploding weight loss market. Right now, we have got Novo Nordisk down by 20.2%, rival Eli Lilly up by 5.1%. Again, recapping, U.S. stocks are rallying, S&P up 78, up by 1.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, the focus on munis is brought to you by Build America Mutual. BAM Mutual. There you go, Charlie. Insures municipal bonds that finance essential infrastructure and provide guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit BAMBonds.com. So good stuff there from our good friends in Lower Manhattan, Build America Mutual. We spent some time down there with those good folks. They do good work for the municipal bond market, investors and issuers. Eric Kozatsky joins us, senior municipal strategist for Bloomberg Intelligence, safely ensconced in our offices down in Princeton, New Jersey. God forbid you get on a train and come to New York. That's okay. They're very comfortable down there in Princeton. Eric, how was your year? How was the year for municipal bonds, and how's it ending up for you guys?
Well, first off, Paul, I didn't come to New York today because it was the last radio hit of the year, and I have Ira eating lunch in back of me. And if I was in New York, we would miss this. Yes, and it's steak day today in Princeton.
That's great.
So I did this for you.
We could do a double, double bill of rates and municipal bonds. How exciting would that be for you?
Yeah.
All right,
like an Ira sort of does a food review at the same time. Okay.
Exactly.
Getting back to munis, right? It had been a great year up until this month. And, looking at the last 10 Decembers, munis were on a winning streak. So this really throws a monkey wrench in sort of the people who love to see a continual streak of wins. Obviously, we're sort of verging on the territory of where we might actually be in negative territory for the year. A little easing on rates today, hoping that's going to put a floor under things and sort of guide us to at least a little bit of green returns for the rest of the year.
I mean, so this is the December metrics. What is the outlook for 2025, and how are really people thinking about the Fed's interest rate cut trajectory and how it could impact the muni market?
Yeah, I mean, we've been sort of tied to the hip with treasuries the last couple of weeks, and it's kind of understandable. The Fed is certainly not helping anything by coming out and sort of being a little bit ambiguous about what they're going to do, and the market has sort of got a little bit over their skis, a little bit of easing today, like we said. Next year, not as many cuts as we originally had thought, and Ira behind me could certainly corroborate that. But I think more important for munis is what our tax situations going to look like, and that's really where everyone in my market is sort of focused for 2025. We had a lot of concern that the exemption may go away. We're not in that camp, but it certainly led to a lot of issuance coming forward into 2024.
In the taxable space, high yield and leverage loans have been the best performers. People are willing to take on additional risk. Is that true within the muni space as well?
Absolutely. I mean, they've been the shining star as far as performance this year, up 5%. But what's more interesting when you sort of pick apart what parts of high yield munis have been the outperformers, it's really been the areas that have gone pretty much unloved since the beginning of the pandemic, right? That hospital, high yield healthcare, senior housing sectors been almost double the returns of the high yield muni index at 10% this year. And areas where we traditionally have seen pretty strong returns, high yield tobacco, really gone unloved and they're in the negative territory for 2024.
Where is money even moving in the muni market in particular? Where are we seeing flows?
Going into really passive structures, I would say. And we're sort of measuring that by looking at how much money is going into separately managed account space. We're probably at that $1.5, $1.6 trillion mark, which makes up a considerable amount of the total muni market. And really, that money flow hasn't abated. Mutual funds have come back this year, but I think they're sort of getting the gist that people want cheaper beta. And we're seeing a lot of new products come into sort of this active ETF market, which are really mutual funds in an ETF wrapper.
Talk to us about new issuance. How has 24 been in terms of municipal bond new issuance, and what's the outlook for next year?
Yeah, I mean, 2024, banner year, given all the volatility and how high rates were, really surprising and took a lot of us sort of by surprise who made prognostications in the beginning of the year. As far as what 25 is going to look like, again, that hinges a lot